To go into the start of cash equity trading and fronting like when London with Tom McKenzie.
And here are your top stories. PacWest seeks to calm sentiment after its stock drops 60% after hours. The lender confirms it is in talks with several potential investors. US futures point higher after the Fed hikes by 25 basis points and signals a pause in its tightening cycle. The ECB is up next, with markets seeing a downshift to a quarter-point hike. European stocks look set to open on the back foot. Plus, Shell maintaining the pace of its share buybacks as the oil major reports another strong quarter. That's despite lower oil and gas prices.
Tom, if you look at the futures, so for the moment we're seeing a bit of pressure. I think the key is actually when the markets fully starts realizing what Jay Powell said yesterday, which is really pushing back against interest rate cuts, and then we have a lot of earnings. Yeah, leaving the door open certainly for a pause, changing the language in the sentiment from the FOMC, the Fed, but as you say, pushing back on that market pricing. And the market pricing, by the way, looking at rates coming down to 4.2% by the end of the year. The pushback was clear from Jay Powell. Cuts are not in the agenda as things stand, but they are data dependent, of course. The FTSE 100 currently down 0.2%. We continue, of course, to weigh up the earnings picture. You've got a lot of numbers coming through from the automakers and, of course, oil and energy, and we'll get the context and the details on that through this hour. The Spanish IBEX currently down 0.4%. And here in the UK, as I mentioned, down 21 points. Over in France, the CAC 40 off by 0.3%. Let's see how the futures in the US are squaring up then as we weigh up not just, of course, the action coming through from the Federal Reserve, the commentary from Jay Powell as well, addressing those banking risks and the debt ceiling crisis as well. There's a lot to fold in as investors weigh up the prospects over the next couple of weeks and months. The banking crisis back to the fore with that 60% post-market drop from PacWest. Yes, they are looking at solutions. Is this contained? You're getting the likes of Bill Ackman and former Fed presidents weighing in with their concerns about the health, the fragility of that regional banking space in the US. The futures stateside then pointing to gains of 0.1% after the losses of yesterday. Euro dollar getting a boost from softer greenback, currently 110 on the single currency, a gain of 0.1%. Brent, you're seeing some upside in oil today. Will it be sustained though? The shorts are out there, the bears are taking positions, and we know that OPEC Plus is now looking to a meeting in June. $73 a barrel, with the context that you're down 40% from the highs of June of last year. Today, gains of 1.3%. Gold, watch the next level, 2075. That is the peak, that is the record for gold. This, of course, on those inflation risks. This, of course, on the idea that maybe getting a pause coming through from the Fed. 2037 per ounce currently for gold. Again, 2075 is the record for the yellow metal. Currently, you're flat. Francine. Now let's dig deeper into the sectors, and out of the 20 groups that make up the Stock 600, I have about half in the red and half in the green. Although if you look at the IMAP behind me or below me, there's a lot of red. Now you're seeing real estate, financial services, energy down between 0.3 and 0.8%. The biggest gainer, basic resources, and then you have chemicals and healthcare on the way up, Tom.
Okay, so the Fed, of course, has hiked, as we mentioned, rates by 25 basis points as expected, and hinted it may have been the last move of the cycle. In his post-meeting press conference, Fed Chair Jerome Powell was asked whether rates are sufficiently restrictive.
It's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made as that would mean we think we've reached that point, and I just think it's not possible to say that with confidence now.
Okay, for more, let's bring in Bloomberg's markets reporter Valerie Taital. Valerie, what were your key takeaways then from the decision, the statement, the language change, and of course the presser from Jay Powell?
Look, it was in that statement that we just heard when he mentioned they're not sure if they're at sufficiently restrictive levels. And they went on to say they need a few months of data to show they even are. I think he got away with what he was trying to do in signaling a pause, but a pause in June doesn't necessarily mean there couldn't be more hikes later if we do get another hot inflation print in the cards. He did spend a lot of time in his opening statement, in his first statement coming out, talking about the recent banking turmoil, saying it has resulted in even tighter credit conditions, but he did paint a rosy picture, saying the U.S. banking system is sound, it is resilient. Overall, Tom, it was a pretty boring press conference. Asset prices didn't move too much. It was the regional bank slide that stole the show that happened nearly an hour after his press conference concluded.
Valerie, thank you so much. I don't know about boring. He did really push back against those cuts coming up. Bloomberg Markets reported their value title and the rest of what we heard from Jay Powell and the Fed. Now, PacWest, the lender at the center of the latest U.S. regional banking turmoil, says it's in ongoing discussions with several potential partners and investors. The bank shed more than half of its value in after-hours trading following a Bloomberg report that it's considering a potential sale. Well, we're now joined by Bloomberg's Tom Metcalf, who oversees all of our banking coverage here in the UK. So, Tom, good morning, first of all. I mean, I thought the banking crisis was over. Jamie Dimon said so, and then now we have PacWest.
I know, you know, when Dimon says something, normally that's what happens.
It happens, right?
No, I mean, very, very big stock rout yesterday, 58% or so down in late trading. And, you know, just clear that investors basically are seen, you know, fleeing for the doors right now from PacWest. So today is the big day. It'll be really interesting to see what happens when New York opens. And obviously, we'll start to get pre-market trading coming through as well.
What are investors going to be looking for? You've had the sell-off. You've had the statement around deposits remaining healthy at PacWest. That's them trying to push back on concerns on that front. And we know, of course, from our own reporting that they are looking for solutions. Where are investors going to be laser-focused today?
I think they'll just be looking for more reassurance. So, you know, a few analysts came out yesterday and basically said, look, you know, no surprise that's what PacWest is saying, but, you know, it's not necessarily the most convincing statement in the world. So I think there's a couple of things. A, they'll be looking at those shares. Will that sort of kind of find a floor? And B, you know, is there sort of a more kind of tangible thing on whether there's a buyer out there, sort of there's actual active interest, or of course there's also discussion of a capital raise. But again, the question is, who wants to put money into banks right now?
Very good question. Bill Ackman also weighed in.
Yeah, exactly. No, he's been sort of banging the drum for a much more holistic solution and saying, look, this is a problem they could have solved, you know, right at the time of the SVB collapse, and just saying, you know, from that one weekend, you've sort of seen all this confidence erode, and basically what happens is, as soon as a regional bank disappoints on the smaller lending side, that kind of sets off this trend of investors fleeing, deposits, you know, in focus.
Yeah, Bill Ackman, he's been consistent on this, on the need for a blanket protection around deposits to get that and restore that confidence. Also interesting to have those former Fed presidents as well coming out, Lockhart, of course, and Kaplan, flagging their concerns about US regional banks. Tom Metcalf, always excellent. Thank you very much indeed for the latest on that. We continue, of course, to watch what is happening in the banking space. It's been a big day for autos earnings as well. VW, BMW, and Ferrari part of the mix today. VW, really interesting in that they've seen some pretty decent numbers coming through. The top line was a beat. They've seen some decent sales numbers coming through from Europe and the US, but a slide in the quarter of about 15%, a drop of about 15% in China. So that is something that so far they've managed to offset. Whether that becomes a prolonged problem for VW is going to be in question. Currently down 0.5%. Again, top line, this was a beat for Volkswagen. 5.7 billion euros in terms of revenues, confirming their outlook and saying that they have a decent order book. BMW seeing losses there of 0.4%. There's also a beat coming through on the sales of some of their most expensive cars, and we know that's been a bit of a theme, that the pricier vehicles have been holding up in terms of the demand there. And they also announced, by the way, last night about a 2 billion euro buyback as well. You can see Mercedes currently falling like a stone, down 7.2%. We're going to get more details, of course, on the autos sector throughout this hour. So check on those movers currently within autos. We do have some sound, though, from one of the executives at VW, beating expectations for the first quarter, as I mentioned, thanks to that strong demand coming through from the US and Europe. The CFO, Arno Antlitz, told Bloomberg's Oliver Crook that he's confident that VW can actually make it work in China. Take a listen.
We develop in China for China to speed up the development. And last but not least, we introduced the ID.7. It's a great car. So with all these measures we have in place already, we are quite confident that we can play a leading role in China in the future.
Okay, that was VW CFO Arno Antlitz speaking to Oliver Crook after the earnings. We're also going to check in on GAM, of course, the asset manager over in Switzerland. Some news there about how they are looking to restructure that business. They're down, by the way, year to date, about 14% the stock. Wow, look at that hit. Down 22% for GAM Holdings. Just trying to get a few more details on this. Again, this is a story around some restructuring. We've seen some outflows as well from this business. So year to date, you were down 14% up until today. So you can look at now, what, 34% or so in terms of the downside year to date. Again, this is the Swiss fund manager agreeing to a $121 million sale of Lion Trust. We will keep across this story for you, but clearly investors taking a turn on that stock. Coming up, we're going to be joined by Virginie Maisonneuve, Global Equity CIO at Allianz Global Investors. A strong guest on a day, of course, when we weigh up the implications of that hike by the Fed, what's going to come through from the ECB, and of course, all the concerns about the US regional banks. Stay with us. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Was going to keep rate World Cup. This is a 3 as the economic picture does.
The BOK is getting ready to make a decision.
Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again.
Well, that was the Fed Chair, Jay Powell, speaking at the FOMC press conference yesterday about the state of the U.S. banking sector. I found it fascinating. A lot of people actually said, look, it's a bit boring. Frankly, he pushed back against market expectations. And if you feel the need to do that, you mean, something's off.
I totally agree with you. All love to Valerie, but no, I do not think it was a boring press conference. We talked about the debt ceiling, talked about the banking crisis, and again, there's the pushback there as well. He said, look, the banking crisis is basically relatively contained. Well, the stock price of PacWest would suggest that maybe that's not quite the case.
There's maybe a little bit banking crisis, or at least an overhang. Now, we're joined by Virginie Maisonneuve, Global Equity Chief Investment Officer at Allianz Global Investors. Virginie, as always, thank you so much for joining us. The focus of the press conference was clearly on trying to tell the markets, look, we'll do more if inflation is out of control, but for the moment, maybe we pause. What was your main takeaway?
Well, I think it's really interesting because the U.S., is sort of 8 months ahead of Europe, right? And if you look at the data recently, and the Fed is telling us it's very much data dependent as this, we reach a point close to a turning point, right? So you had the first quarter GDP data that was really on the weaker side, 1.1% versus from 2.6%. And really a mixed picture in terms of investment down, resi down, non-residential down as well, and a consumer relatively resilient. At the same time, when you look at inflation, there is stickiness. So I think, we'll probably have that next 25 bips increase, but after that, it's looking at how much tightening in the system is impacting not only the banking system, but inflation. And this is going to be, the next 2 or 3 months are going to be really data dependent, as they mentioned. And I think they want to guide to that uncertainty, if you want. That's what the message is.
Virginie, is financial conditions now the metric, the primacy there? Is that where the focus should be versus inflation at this point?
Well, this is really the point. Over the next 2 or 3 months, we're going to shift from rates to growth. That I feel very strongly about that. Now, tightening of financial conditions, as we know, we've worked on them, and this has been in the making for a long time now. If you look at monetary supply growth, for example, if you look at M2, the decline has been very sharp for a long time. But of course, because we started with the COVID support with a much stronger, I would say, liquidity in the system, the timing of the impact is very hard to judge. It's a little bit like when you go into one of those balloons and they put the gas up. It takes a few seconds delay to move the balloon, and I think there, because of all the liquidity, it's been harder. But clearly, what's happening in the regional banks area is a signal that we're probably getting close to the end of that tightening monetary supply, tightening and rates, etc. At the same time, we can't stop too early. And inflation, as we've seen with the latest PMI numbers, inflation is sticky because of pricing in the manufacturing sector, and that's really important to watch.
Virginie, talk to us a little bit about earnings. So you're expecting earnings, so compared to the ones that have not reported yet, we could see a little bit of a deterioration.
Yes, exactly. So far, I would say earnings have been beating expectations, right? If you look at the US, about 70% of companies that have reported so far have beaten because people had taken down their expectations, right? Net income surprise, sales surprise, etc., and the tech sector leading. Now, companies that have reported are reporting now are a little bit more disappointing, but I think for me, the key takeaway is this first quarter earning, in a way, is the legacy of the past. What do I mean by that? Some companies really took advantage of what I call greedflation, right? Inflating prices as inflation movements, if you want, was underway. And of course, perhaps at the detriment of volumes. Next quarter and the following one, we're going to see the dust settle, if you want. And if you look at those PMI numbers in the US that came out, it's really, really interesting because you see that price, industrial price and goods prices increase, which is a reflection of what you've seen in the earnings numbers.
Okay, the prospect of greedflation, whether or not that starts to fade. When it comes to the tech sector, Virginie, do you want to up your exposure to technology, given how well it's performed, given the strength that's come through in the earnings, or do you want to fade that rally?
So, my view as a long-term trend sort of investor, I think you have to be in the tech sector. Now, of course, we've had a strong rally, and I think it goes back to being stock by stock. If you think that during the rest of the year, you're going to see a strong deceleration of growth, which we're likely to see, you really have to pick the names because you'll have that cyclical element of growth decelerating at the same time where you have structural trends around usage of artificial intelligence, cybersecurity, all the trends that we've talked about for many years that are still there. So I don't think it's a top-down sector weight allocation, but it's really a bottom-up opportunity and looking at price disruption if in fact we have volatility in the market.
Okay, wonderful to get your thoughts on a really big day for these markets. Another big day for these markets. Virginie Maisonneuve, Global Equity CIO at Allianz Global Investors. Thank you. Coming up, Volkswagen beat expectations for the first quarter, but sales in China lost ground. We're going to be more of our interview with the CFO and COO of that business, Arno Antlitz. That is next. This is Bloomberg.
Is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
Welcome back to the Open, everyone. 21 minutes into European trading day. For the moment, we're bracing. Markets and traders, Tom, are bracing for the ECB. I don't know whether we'll get anything like the Fed, but certainly yesterday was about the Fed, and three things ECB watchers are looking for, and that will then determine what stocks are doing, the size of the hike, the path ahead, and the asset portfolio. Not dull.
Maria, not dull for the ECB. Maria today, we know, is on the ground, going to give us all the context on that. And of course, we will be listening in to Madame Lagarde and her guidance as well around rate hikes. But we also have the earnings picture as well to work through.
Now, Volkswagen beat expectations for the first quarter after rising deliveries and strong demand in the US and Europe helped offset a slide in sales in China. The CFO, who's also the COO, Arno Antlitz, spoke to our Oliver Crook earlier.
The competition will increase. Look, with semiconductors supply improving, with demand is slightly coming down, Q3, Q4 will see a much intensified competition, and we're preparing for that accordingly. On the one side, we have this strong product substance, but on the other hand, we are not naive. We have to prepare on the cost side, both in terms of productivity, in terms of fixed cost discipline. We need a program at brand Volkswagen to improve margin. So these are the things we set up right now.
And then something that this quarter was also marked by, obviously, the launch of the model behind you, but also your entire board went to China. What did you leave that visit with?
No, you're right. We have been in China. I personally also spent 3 days in China. We had a look at competition. We talked to the teams on the ground. We talked to customers. We talked to our JV partners. And it's clear we have a very strong position in China. But although we have that strong position, we have to accelerate. We have to accelerate specifically on the BEV side. And I would say in three dimensions. First, in ADAS, so in driving assistance function, in in-car infotainment, but also in general in the overall speed at which we adapt to local Chinese customer needs. And in all these three areas, we made significant decisions already. We teamed up with Horizon Robotics on the ADAS side. We created some JVs and some collaborations on the in-car infotainment. And most importantly, we founded the 100% TechCo with, in the midterm, 2,000 developers on the ground in China who develop in China for China to speed up the development. And last but not least, we introduced the ID.7. It's a great car. So with all these measures we have in place already, we are quite confident that we can play a leading role in China in the future.
And are you targeting a certain proportion of the market in China that you think you can achieve? Obviously, in the first quarter, one of the stories was that BYD overtook Volkswagen. How do you win back that crown? Is it down to that recipe that you have just given, or is there anything else you can do? And sort of what are you aiming at? What do you think is a good proportion of that market?
Yeah. No, we are still a market leader in ICE cars. That's obvious. We had a slow start in BEVs in 2023, but we want to pick up in the remainder of the year. But for China, it's true what we always say for the rest of the world. We focus on the quality and margin of the business rather than on volume and market share.
And then everyone seems to have had a fairly good quarter in the first quarter, but everyone's a bit hesitant about the sort of outlook. For you, in your mind, is that to do with the sort of more macro conditions of, a global slowdown, the Fed, and all that's going on with interest rates? Or to what degree is it that, and to what degree do you think it is specifics within the auto sector? I'd like if you could draw that distinction between the sort of the macro and what you're looking at in the auto sector.
Yeah. No, of course, we look into a challenging environment. We have a discussion around banks. And we have inflation that obviously gives some uncertainty. For the auto sector, we still believe the sector the overall industry will increase by 7 to 8%. This is our current assumption. But yes, there will be increased competition in the second half of the year. But as said, based on a good product substance, strong product substance, based on our strong brands, and we're preparing on the cost side, we are quite confident that we can achieve our outlook, financial outlook, specifically also in terms of our margin target between 7.5% and 8.5%.
That was the VW CFO speaking to Bloomberg's Oliver Crook earlier. On the back of those earnings, currently you're seeing European stocks down 0.8% and autos amongst the biggest losers, currently down 2.3%. Let's check in on some of the individual names. We have Mercedes ex-dividend on the back, of course, the move coming through then on the back of that ex-div. Of course, for Mercedes, GAM, really interesting. Wow, they're selling themselves to Lion Trust for what, 121 million US dollars. GAM selling themselves or agreeing to sell themselves to Lion Trust. Shell coming through with a very solid beat on first quarter adjusted profit, 9.65 billion, well above the estimates of a little over 8 billion, and saying that the share buyback program will be maintained. Plenty more coming up. The focus on the ECB. This is Bloomberg.
not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. PacWest seeks to calm sentiment after its stock drops 60% after hours. The lender confirms it's in talks with several potential investors. European stocks and U.S. futures dip after the Fed hikes by 25 basis points and signals a pause in its tightening cycle. The ECB is up next, with markets seeing a downshift to a quarter-point hike. Plus, Shell soars after the oil major maintains the pace of its share buyback and reports another strong quarter despite lower oil and gas prices. Tom, if you're looking at oil, it's actually getting, WTI is crashing. There's a lot going on today.
In fact, it's the only sector, only sector actually in the green today. But with the context, as you say, that you've seen about 40% downside for Brent since the peak in June, since the high in June, certainly. You're seeing gains across that sector, energy of about 1.5%. Oil, WTI and Brent are currently up in the session. OPEC Plus, interestingly, calling a meeting in early June. Brent currently at $72 a barrel, WTI at $68.99. Across the major indexes then, yes, losses of 0.7% across the broader benchmark here in Europe. You're weighing up the earnings picture that's coming through with, of course, that hike from the ECB that is expected. Whether they go 25 or 50, still, of course, weighing up the commentary from Jay Powell. He doesn't expect a recession. He thinks the banking crisis is relatively contained. A lot of commentators pushing back on both of those themes. The DAX currently down 90 points. The FTSE 100 here in the UK off by 0.4. On your sectors then, as I mentioned, and let's switch it over, it is energy that remains the one sector in the green in the session this Thursday morning, currently up 1.5%. The biggest losers coming through for autos down 2.1%. Media also in similar territory. Travel and leisure also taking a hit 1.2%. It is a risk-off move across these equity markets, and we're waiting, of course, for more clarity coming through from the ECB. Worth mentioning that in terms of the upside that's coming through across commodities, it's gold that's getting a bit of a lift, currently at 2,032. It's down 0.3 on the session, but it's closing in on a record high of 2,075 per ounce for the yellow metal. The central bank action, of course, central to how things play out for gold. Fran.
So, Tom, we've been talking about it all morning. The ECB poised to slow the pace of interest rate increases later today following a two-day meeting in Frankfurt. It comes after data showed core inflation cooling in the euro area in April while credit conditions tightened, pegged to turmoil in the banking sector. Now, for more, let's get straight to Bloomberg's Maria Today, who's outside the ECB in Frankfurt. Maria, three things that investors want to know: the size of the hike, the path ahead, and, of course, the asset portfolio.
Yes, absolutely, Francine. And I think when you look at the rates and the hike potentially to come today, it is pretty much understood the European Central Bank will hike again. And how can they not when you see headline inflation that still covers around 7%, obviously way above that target of close but below 2%. I think in terms of the size and the magnitude, there is debate, although the call that carries momentum going into the meeting is at 25 basis points, which would be, and you alluded to this, a downshift from the European Central Bank. We had a lot of data over the past week. You saw that lending survey that did point that some of the jitters in the banking sector also fed through European banks and the credit conditions for households, but also firms in the euro area. And then, of course, that print, closely watched core inflation for April, which slowed a touch to 5.6%. All of this, you put it together, you could argue there is a case that the monetary policy is working, is feeding through, but also a word of caution because of the situation in the banks, which we saw play out overnight, has not really calmed down in the United States. So again, going into this meeting is at 25 basis points. That takes the momentum in this meeting, but there are some calls out there which still say 50 basis points could be warranted. It's an economy that is still pulling along and inflation still unacceptably high.
Yeah, and you'd have to wonder, of course, what the market reaction would be to a 50 basis point move from the ECB. It's always a fine line, isn't it, for Christine Lagarde and other central bankers at these press conferences. What are you going to be looking at in particular, Maria?
Yeah, especially, Tom, on a day where you see it. I mean, there's nervousness that it still plays out, and you still had the mid-tier banks in the U.S. under pressure. A lot of that already fed through in the previous meeting, where the European Central Bank also stressed, by the way, that they had to watch out both the inflationary pressures, but also the financial stability, and saw no trade-off today. Whether they repeat that line will be interesting to see in the press conference. Now, in terms of what more to watch out for, it's QT2. By now, we know that this is a twofold decision. If you go softer on rates, the implication is that you would hint at an acceleration when it comes to QT. Whether she also refers to European banks today because of the jitters overnight, that will be also interesting. And then I think in terms of the forward guidance and the sequence that Francine alluded to, this has been a central bank that went from very explicit forward guidance to actually saying we will take it meeting by meeting, look at the data, and in particular, core inflation. Will she repeat that? I think also that's worth noting, and watching out for.
Okay, Maria Tadot, excellent. Thank you. On the ground for us in Frankfurt. Will be across the story for us throughout the day, of course. Let's get more analysis then with Anna Titareva, UBS European economist. Anna, thanks for joining us in the studio. Do they go 25 or 50?
Well, our base case is they go for a 25 basis point hike. That's been our base case for a while, and we confirmed it after all the data that we got on Tuesday. Because on balance, we thought that inflation wasn't too bad. We did see a marginal tick up in headline, but that was in line with our expectations. We did see some first signs of core inflation easing. On the growth side, activity data that we got on Friday didn't show any big upside surprises, and in fact, it was exactly in line with the previous ECB projections. And finally, on the bank lending survey and credit data, signals were mixed, showing that credit conditions remain tight, but didn't show any big negative downside surprises.
And are you still expecting some kind of language like further tightening may be needed? And does what Jay Powell say yesterday change everything also for the ECB?
Well, we still think that inflation outlook in Europe remains very challenging. We also need to distinguish between differences in inflation dynamics in Europe versus the US, where in Europe, wage growth is still accelerating. We expect it to accelerate throughout the first half of the year, which is likely a big concern for the ECB in terms of inflation persistence. So against this backdrop, we can argue that ECB is under more pressure and is likely to keep a more hawkish tone.
Core, you talked about core because there's been a lot of focus on that. It was remaining pretty sticky. It's edged down. How much confidence do you have that it is on that downward trajectory now?
In terms of level of confidence, it's hard to say, but I think if we look at the start of the year, where the biggest upside surprises came from was actually goods inflation. And the fact that lower energy prices and easing in supply bottlenecks took much longer than expected to feed through in lower goods inflation. Now, when we look at the last two inflation prints, we finally start seeing signs of goods inflation coming down. Services inflation, of course, remains a concern, but at least we do see a bit more persistent signs of goods inflation coming down.
What's the biggest concern right now that you think? I don't know how Christine Lagarde actually manages the message so that the market get it, but also, you know, they deal with the potential fallout in banks. Are the banks safe, or should Europe be on tenterhooks?
Well, we've seen a bit of a difference in language between Europe and US, where European policymakers and also politicians kept emphasizing that banking sector is in a good shape. So I think that line we'll see being repeated a number of times. But of course, the ECB does face uncertainty about how much the tightening that they've already delivered means in terms of economic impact, in terms of financial conditions tightening. So there is uncertainty, but we wouldn't expect any significant change in the language around the financial sector.
And you talked about the bank lending survey, and it's remarkable to see that the demand for loans, the corporate demands for loans in Europe, falling to the lowest level since the financial crisis. Are we at the bottom, or do you think that demand and that tightening around lending conditions and credit conditions, do you think that persists?
So indeed, it was the biggest surprise from the whole survey to us to see the decline in demand. It's hard to say at this point whether we hit the rock bottom. Also, we need to keep in mind that this is sort of perception of banks, whether that translates into an equivalent drop in lending dynamics. You know, it's early days to say, and this is something that we'll be watching very closely.
And a lot of the focus, well, actually not a lot of the focus, and maybe we should spend a little bit more focus actually on the balance sheet of the ECB. What are you expecting there?
So we are expecting essentially an automatic decline in the balance sheet, and at least in the next few quarters, it's largely going to be driven by maturity of a number of TLTRO operations. We do expect a big repayment in June, around 600 billion. So that automatically is going to bring down ECB's balance sheet. Now, when it comes to the runoff of APP and PEP program, there I would emphasize that we don't expect an announcement on the APP runoff today. We think the decision will be deferred to the June meeting, but we expect that to continue at a gradual pace.
You have a terminal rate forecast of 3.5%, correct? But you haven't discounted 4% as a possible outcome in terms of highest rates out of the ECB. What does that do to the Eurozone economy if you were to get 4%? I know it's not base case, but what is the economic impact of 4% if that comes through?
Well, we know that the uncertainty bands around this sort of estimates about the pass-through are very high, but based on, for example, the ECB's work itself and what Philip Lane has recently mentioned, is that every 100 basis points hike could subtract around 0.3 percentage points from inflation, and then it's worth about 1 percentage point in terms of growth impact. So very significant growth impact, but in general, we think that there is high level of uncertainty around that, especially given how tight and resilient labor markets remain.
Anna, thanks so much, as always, of course, for all of your insight and wisdom on the ECB and monetary policy. Anna Titereva, UBS European economist. Now, later, we also bring you live coverage of the ECB's rate decision, as well as Christine Lagarde's press conference. That starts, don't miss it, 1:15 UK time.
It will not be dull. We'll also get reaction from former ECB Chief Economist Peter Prett. Do not miss that conversation. Some with deep insight, of course, on the thinking of the ECB. That's just after 4 p.m. London time. Coming up, VW and BMW reporting, of course, earnings this morning. Both surprising to the upside. The market's not overly optimistic, though, about the prospects. Can the momentum last in terms of the numbers coming through from these automakers? We're going to break down the numbers and discuss. That is next. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence, it's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to the Open. We are 44 minutes into the European trading day. You're seeing losses across the benchmark of 0.3%. The Fed coming through with 25 basis points, clearly leaving the door open for a pause. The ECB up next. Will they go 25 or 50? UBS thinks 25 is more likely. Futures in the US turning more positive now. S&P E-minis up close to 0.2%. NASDAQ futures currently up 0.4. Let's get back to the earnings story, though. Volkswagen beating expectations for the first quarter after rising deliveries and strong demand in the US and Europe, helping to offset a slide in sales in China. Let's check in on some of the auto stocks then before we cross over to Ollie Crook, who's been covering all of this for us. So VW currently down about 0.7% as a sector, Ollie. You're looking at losses now of 1.5%, one of the leading in terms of the losses across the trading session, at least on this Thursday morning, the auto sector. Ollie, break us down or break down what we've been hearing from VW. A little bit of optimism coming through from the US and Europe, but concerns about China. What stood out for you?
Yeah, take no joy in breaking you down, Tom, but really looking at these numbers, it's all about the outlook. A very solid quarter for the earnings across the auto industry, really seeing pricing holding up, volumes crossing up, but it's all about the outlook. Let's talk about VW very quickly. Sales beat up 22%, margins beat. You have strength in the US, you have strength in Europe, you have on both volume and pricing, but you have to look at China. This is the single biggest market for all of these car companies. Sales in China down 14.5% in the first quarter. The first quarter also marked by BYD, the Chinese EV maker, overtaking Volkswagen for the first time, taking that crown from VW in terms of sales volume, which is a market that VW has dominated since the 1980s, so a significant benchmark. They are aware of this problem, and they believe that a new sort of product mix and all these new vehicles that they're putting on the road is sort of the antidote to fighting this. They have the ID.7, that was in the background of the shot when we spoke to the CFO a little earlier. I also asked him about pricing and whether they're going to have to engage in a price war with Tesla. He says that no, that they really need to maintain those margins. They may look at cost, but that's sort of the picture going forward.
Yeah, what's interesting, Ollie, if you look at BMW and if you look at Mercedes, and Volkswagen in general, they're basically marketing to the higher end to make up the cost of then producing some of the EVs.
That's exactly right. And that's sort of the situation that all these legacy automakers are in, where they know how to make money on the ICEs. They know how to get, strong margins there. And they need to take all that money, funnel it into R&D and marketing and all this other stuff for their electric offerings so that they can hopefully attain margins like Tesla at some point. But for BMW, they have €2 billion euro share buyback, which is going to be sort of an active factor in the market today. Pricing, again, the main theme, as you say, Francine, your taste of Rolls-Royce and the 7 Series, all the things that basically created a margin for them that was absolutely monster, 12.1%, beating the range of the estimates for 7%. But again, you look at the sales volumes in America, in the Americas, up 11.4%. 4%. In Europe, down 2%. China down 6.6%. So really a very strong quarter across the auto market for a lot of these companies, but very guarded on the outlook.
He knows you well, Fran.
Yeah, I mean, everybody knows that I'm only a Fiat girl. I'm in like a Fiat 500, one of the old ones.
Oh, they're nice, classy.
Or maybe I would do a Ferrari if I could afford it.
Okay, upping on Ferrari. I've got an image of Ollie Crook in a Lada, stepping out in a Lada, in that beautiful sunshine. It's a lovely day in
Maybe a
Perth.
Citroën DS.
Citroën DS.
I love
Very
that.
nice.
The old
Baby
one.
blue, Oliver Crook.
I hasten
Thank
to
you
add.
so much. Of course, always vintage Oliver Crook in Berlin with some good taste in cars. Let's get straight to the Bloomberg First Word News with Samuel Etienne. Hi, Etienne.
Hi, Francine. Volodymyr Zelensky has denied Ukraine was behind a drone attack on Vladimir Putin's residence in the Kremlin. Speaking while visiting Helsinki, Zelensky says Ukraine only fights in its territory and that Moscow may be trying to distract from its battlefield failures. Unverified video from social media shows what Russia calls an attempt on the life of the president and a planned terrorist attack. And Saudi Arabia is reportedly preparing to offer football superstar Lionel Messi a $400 million contract to move to the Saudi Pro League. Messi is currently contracted to Qatar-owned French club PSG, but was suspended this week for traveling to Saudi Arabia without permission. The reported sum far exceeds the more than $200 million Cristiano Ronaldo secured to play in Saudi Arabia until the summer of 2025. And Vodafone and CK Hutchinson are reported to be close to agreeing on a combination of their UK telecoms businesses. According to the Financial Times, the deal is set to value the equity of the new group at about £9 billion. The combination of Vodafone and Free will create Britain's largest mobile operator. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Francine.
Thank you so much, Etienne. Now, coming up, Shell maintains the pace of share buybacks as it reports another strong quarterly profit despite lower oil and gas prices. We'll get more on those results next, and this is Bloomberg. So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
maintain, as we said actually in February, that we will have a $17 billion dividend in total, with both the ordinary dividend and extraordinary dividend and the share buyback. So we will continue that for the 2023. Then remember, 2022 was a very special year, and we have a very, very strong balance sheet. But we have said very clearly that we will use capital distribution as a tool to move to a more optimal capital structure.
Okay, the CEO of Equinor speaking to me and Manus Cranney earlier this morning. The company reporting first quarter profits that beat estimates. Now, we've been talking about the resilience, the relative resilience of the Eurozone economy, calling into question now, arguably at least around the services picture in France. April services PMI coming in well below the prelim number, currently at 54.6 for the month of April. Services PMI for France. The prelim number had been 56.3. Euro moving lower on this, despite dollar softness as well. The euro is down now about 0.1% on the back of this line, currently at 110. Of course, this all ahead of the ECB decision later today, Fran.
Tom, let's look at Shell. So, I mean, we've had a lot of, some of their peers actually putting out some pretty incredible figures, and also a lot of pushback because of the cost of living crisis and what they could do to give back a little. But today, Shell saying that they will maintain the pace of share buybacks. It did report another strong quarterly profit despite lower oil and gas prices. Now, it does contrast in general with BP, which saw its share price drop more than 8% a bit earlier. So you see gaining 2.3% for Shell, Equinor gaining 4%. Let's also bring in Bloomberg senior oil reporter Stephen Stepczynski. Stephen, what can you tell us about what happens to oil from now on?
I think when you look at the oil prices today and over the last few weeks, we've been trending downward. I think you could say that the bears are in control to some degree of the market. There is a fear that a U.S. recession is going to further reduce demand. Also, the risks of a tight market later this year might be sort of disappearing to an extent, especially as Russian flows of oil continue to be quite resilient. And Chinese demand isn't picking up to the degree that some in the market were expecting. All of that together is making a bit of a bearish sort of push down, and also volatile market. Here early in Asia, you saw WTI fall 7% early in the morning. It's not exactly clear why that happened, but it bounced back immediately afterwards. But there are jitters. There's not much liquidity, and volatility will continue going forward for oil.
Okay, Stephen Stepczynski, our energy reporter, of course, breaking down what's happening across the oil space. Currently, Brent at $73 a barrel, a gain of a little over 1%. We, of course, look ahead to that OPEC Plus meeting in June. On the economic front of the Eurozone, we touched on French services PMI for April. Germany now coming in, and it's a slightly different picture versus what's happening in France. It's actually a beat, or at least higher than the prelim numbers, 56, so comfortably in expansionary territory in terms of German April services. The prelim number had been 55.7. So 56 is the number for Germany. Just recapping what happened in France. April services PMI coming in below the prelim number, being revised down to 54.6. Euro dollar at 110. A little bit softer on the back of the data that come out of France. You're looking, of course, as well ahead to that ECB decision. The debate as to whether they go to 25 or 50, Fran.
Yeah, that's, of course, the main question. People want to know exactly what the path ahead and what that means for euro dollar. So that's it, Tom, for the European Market Open Surveillance Early Edition is up next. We'll also be talking April spritzes. No, we won't. We'll talk to the Campari chief executive, so might as well. We'll talk a little bit about the coronation because I have a UK special, but of course, full focus on euro dollar and the ECB later. This is Bloomberg.
product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
Are we underpricing here in Europe, and just how far the ECB could still go?
We really haven't seen an impact from the hiking cycle on inflation yet.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference. Coverage begins Thursday on Bloomberg, your global business authority.
Back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. PacWest seeks to calm sentiment after its stock drops 60% after hours. The lender confirms it's in talks with several potential buyers or investors. Will bring you pre-market moves. U.S. futures point higher after the Fed hikes by 25 basis points and signals a pause in its tightening cycle. The ECB is up next, with markets seeing a downshift to a 25 basis point hike on signs that inflation may be topping out. So good morning, everyone. Also, May the 4th. I know for a lot of the Star Wars fans out there, May the 4th be with you, but never mind. We have to get to data. Euro area April services PMI coming in pretty much in line with expectations, maybe a touch below expectations because we got 56.2. Remember, anything above 50 means we're in expansion territory, and actually what we were expecting, the preliminary figure, was a 56.6. Now, the focus firmly on the ECB after we had Jay Powell yesterday. If you look at European stocks, a lot of concern about earnings out there. Now, be prepared for a rate decision from the ECB to maybe move some of the expectations. Certainly on some of the currency, the dollar for the moment extending a decline. And then you look at Shell, one of the biggest gainers in today's trading session after it maintained the pace of share buybacks. It also reported another strong quarterly profit despite lower oil and gas prices. But then the earnings picture for a lot of other sectors, maybe not as well. Some of the other things we're looking out for is not only the price of oil, but of course the regional lender PacWest and some of the anxiousness we're seeing in U.S. regional banks in the U.S. Does that spillover impact Europe and impact the ECB's thinking? The picture overall for a lot of these indices in Europe is still down. Again, it could move fairly quickly, but look, the rate debate resumes with policymakers, deposit rate being seen gaining a quarter point to 3.25%, which would really mark a slowdown in the hiking cycle from the ECB. This is a picture for the banks. PacWest, the one story that we are really following very closely for the twists and turns. We have our reporters on the ground who've been speaking to people familiar with the story, saying they're now looking at all options, including a possible sale pre-market. Another huge sell-off for PacWest, down 44%. So the Federal Reserve has hiked rates by 25 basis points, hinting that it may be the last move of the tightening cycle. Meanwhile, these PacWest shares pre-market plunging following this Bloomberg report that the U.S. regional bank was said to be weighing options, including a sale. Overnight, just to reiterate everything we know, we learned that PacWest has been approached by several potential partners and investors. Despite the banking turmoil, Fed Chair Jay Powell was more optimistic.
Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again.
Well, we're now joined by Catherine Neese, Chief European Economist at PGIM Fixed Income. Catherine, thank you so much for coming on. I thought Jay Powell yesterday was fascinating because he had this really tough job of dealing with the banks, pushing back against market expectations, you know, with a cut later this year. How do you think he did?
I think he did a good job. It's a difficult job. The central banks, including the U.S. Federal Reserve, very much trying to balance between not wanting to be seen stepping back from achieving their inflation mandate, but at the same time not appearing tone deaf to what is going on in the banking sector and these fragilities. Clearly that's going to be adding to the tightening and credit conditions in the U.S., and they really just don't want to overdo it.
But so is the market pricing in things correctly, or are we going to see a Fed pivot?
So my concern up until now has been that perhaps the market's been a little bit too sanguine about some of these tail risks. It might not be a base case, but there's a good plausible chance that we could see some of these tail risks crystallizing, things like a more serious recession, a downturn in the U.S. We could also, of course, see more negative supply shocks at the global level hitting Europe that have spillover impacts on the U.S. So a bit of that complacency does worry me to a degree.
And so what I found fascinating is that so far the Fed also tried to say, look, we're dealing with inflation, but didn't really want to do anything with interest rates to deal with the possible credit crunch and the banks. I don't know whether that's a fair analysis and whether yesterday was a turning point in that fight.
Well, using interest rates is to deal with what is potentially a financial stability risk is a very blunt instrument. And there are other instruments at the disposal of the central banking authority in the U.S. and at other central banks, and those will be better suited to addressing those pockets of risk where they see them. But that's not to say that monetary policy is going to completely disregard these financial stability risks. I think after the global financial crisis, you saw a number of central banks embed into their flexible inflation targeting strategies a recognition that monetary policy does need to be alive to these financial stability risks. And for me, what that means is a shallower rate path, and perhaps the destination is lower than it would otherwise be. And I think we saw hints of that in the Fed meeting yesterday.
Thank you so much, Catherine Neese at PGIM, Chief European Economist. Of course, she stays with us, and we'll have plenty more on everything to do with the European Central Bank and, of course, what comes next in terms of Bunds and BTPs. The European Central Bank set to publish its latest rate decision today comes after data showed core inflation cooling in the euro area in April, while credit conditions tightened after the banking sector turmoil. For more, Bloomberg's Maria Tadeo is outside the ECB in Frankfurt. Maria, good morning again. So we are expecting a hike. The real question is by how much and what other tools do they have at their disposal?
Yes, Francine, and you have the ECB watch, by the way, the Coronation watch, the Fed watch. You have something for everyone in this show. But in terms of specifically here in Frankfurt, by now it's pretty much understood. The European Central Bank, as you say, will hike again. How can they not when you see headline inflation, which is their target to hit that close but below 2%, still moving around the 7%. And then that takes us to the question of how much, what is the magnitude, though, of this hike to come today? And Francine, I think we've talked about this the entire morning. There is this idea that the call that carries momentum is at 25 basis points because of all of the data that we had over the past week. You had that lending survey, which obviously the market was paying very close attention to because of the jitters in the banking sector, which continue, by the way, in the mid-tiers when it comes to the U.S. And then, of course, that core headline, core inflation that came in at 5.6%. Remember, the ECB said that may not be the target, but is a number they closely watch to see whether transmission is working. That cooled down in April. In many ways, if you put all of this together, that would back the case for 25 basis points. There are some calls, I'm looking at Credit Agricole, which say we stick with the 50 basis points. This is still inflation way too high in an economy that is still pulling along. There is a case to go aggressively, but going into the meeting, it's the 25 basis points that takes it from a market perspective. Obviously, nothing official until Madame Lagarde makes it official.
So, Maria, when you look at some of the other things that we're watching out for, I mean, does the balance sheet naturally, continue on the path that we've seen so far, or could we see more news on that?
Yes, and that's an excellent point, Francine, because one of the trends that we've seen is that when you look at a rate decision like this and just that move, it is a twofold package when you look at QT. The idea is that when you go softer in rates, that imply or would mean that you have to go faster or imply an acceleration on QT. That is a way in which you get to a majority or a large consensus around decisions like this. You have to give something to everyone. It's a constant give and take when it comes to 20 central banks that have to set monetary policy together. The other issue beyond the QT and the rates, which as I say in many ways are combined, is one is whether or not Madame Lagarde will again comment on the banking situation. That is not over by any means overnight, that news flow from the US, and whether she'll reiterate what has been the guidance until now, that given the uncertainty, this is a central bank that will focus meeting by meeting, look at the data, still monitor core inflation, but also the transmission of this monetary policy.
Thank you so much, Maria Tadeo. They're outside the ECB in Frankfurt. Now, a little bit later, we bring you live coverage of the ECB's rate decision, as well as Christine Lagarde's press conference. That's from 1:15 UK time. Now, still with us, Catherine Neese, Chief European Economist at PGIM Fixed Income. Catherine, so many questions, actually.
It's much more clearly been on a declining trend in the US, whereas in the euro area, it's still been on an upward march. So that does put, I think, the ECB into a different space. In terms of today's meeting, I would have thought that they would want this to be a no surprises meeting, to deliver on the expectations that Maria, just set out of a 25 basis point rate rise, to say something about perhaps accelerating the pace of balance sheet runoff. And frankly, I do expect them to continue with a more hawkish tone than what we heard from the Fed chair, simply reflecting that differential inflation picture in the euro area. But nevertheless, a step down from 50 to 25 is notable.
So, and does it mean that actually they worry less about inflation, or that they worry about a recession? I mean, this is, if we look at, possible recession in the euro area, this will be central bank made. So could we see a recession that's actually much more shallow than previous ones?
Well, I think, if anything, we have been surprised by the resilience in the euro area coming through this winter. You mentioned some of the data that's just come out on the PMIs. I and many others were expecting that we were going to see a really significant recession through the winter as the region was, in short order having to wean itself off of Russian gas. And instead, we've seen, a much more resilient picture. The latest data are saying the recession has been averted. But nevertheless, I do think the ECB, like the Fed, are going to be worried about overdoing it. They've done a lot of interest rate rises over an exceptionally short period of time. The balance sheet contraction is pushing in the same direction of tightening credit conditions. And of course, now the US banking sector fragilities, even if you don't have any contagion risk in Europe, that will be adding to globally tighter credit conditions that the ECB needs to be mindful of.
Catherine, thank you so much for all of your insight. Catherine Neese there, Chief European Economist at PGIM Fixed Income. Now, coming up a little bit later today, we'll be speaking to the former ECB Chief Economist, Peter Prett. That's just after 4 p.m. London time, 11 a.m. in New York. Stay tuned for that. Now, let's also look at some of the pre-market for some of the banks. This is the story, of course, that we'll keep a focus on. This is after Bloomberg scoop yesterday is saying that, well, certainly PacWest Bancorp is looking at all options, including a possible sale to investors. Now, yesterday, actually after hours, that share price was down 60%. Pre-market, it's down now 40%. But if you put that in context, over the last week, it was down 10% on Monday, it was down 30% on Tuesday. So it's been cried around for this bank. We'll have much more on what that means going forward. Also, we look at the Aperol maker Campari defying consumer gloom with the sales beat. We discuss the demand for tequila, for bourbon, and aperitifs with the chief executive, Bob Kunze-Koncewitz. That's coming up next. It's an exclusive conversation, and this is Bloomberg.
Okay, so you're moving in on me, quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
Just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
This is Bloomberg.
Let's get straight to the Bloomberg First Word News. Here's Alex Morgan. Hi, Alex.
Hi, Frank. Good morning. Vladimir Zelensky has denied that Ukraine was behind a drone attack on Vladimir Putin's residence in the Kremlin. Speaking while he was visiting Helsinki, Zelensky says Ukraine only fights in its own territory, saying Moscow may be trying to distract from its battlefield failures. Well, unverified video from social media shows what Russia calls an attempt on the life of the president and a planned terrorist act. Bloomberg has learned that President Biden has selected the Federal Reserve Governor, Philip Jefferson, for a promotion to vice chair. Biden will also nominate World Bank economist Adriana Kugler to an open board slot, becoming the central bank's first ever Latina policymaker. Well, both nominees fill roles left vacant by Lael Brainard in February. A 13-year-old student has been arrested after opening fire in their school in central Belgrade yesterday. Serbian police say 8 children and 1 guard are reported to have been killed and 7 others injured. That's Global News, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Alex Morgan, and this is Bloomberg. Francine.
Thank you so much. Now, coming up, we speak to the Campari Group Chief Executive Officer, Bob Kunze-Concewitz, off the back of their recent first quarter sales beat. So we'll come back to that. We'll talk about drink trends. We'll also talk about the U.S. market. This is Bloomberg.
Thailand is holding a general election on May 14th, and the race to be the country's next prime minister is heating up. Dozens of candidates are eyeing the job, but the contest is expected to be mainly between candidates of the pro-establishment groups and a pro-democracy camp of opposition parties. On the one side, we have General Prayut Chan-o-cha, a 69-year-old former army chief who seized power in a military coup in 2014. He has ruled Thailand for nearly a decade since and is seeking another term under the banner of the conservative United Thai Nation Party. On the other side, there's 36-year-old Paetongtarn Shinawatra, the latest political figure from the Shinawatra clan that's dominated Thai elections but been routinely booted out of office. After stepping into politics in 2021, she's now seeking to follow the footsteps of her father Thaksin and Aunt Yingluck, both former Thai prime ministers and both toppled in military coups 8 years apart. Paetongtarn has been leading in most popularity polls and winning approval ratings for opposition Pheu Thai party. Other candidates to watch out for from this camp are Sethta Thavisin, a former real estate tycoon who was also nominated for prime minister by Pheu Thai, and Pitta Limjaroenrat, leader of the progressive Move Forward party that's popular among young voters.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, consumer demand for aperitifs, tequila, and bourbon have helped Campari Group to a first sales beat. Now, the Italian beverage maker reported organic growth in the U.S., its largest market, boosted by a double-digit rise in Wild Turkey bourbon sales. Aperol, meanwhile, saw triple-digit sales growth. People are drinking too much. Off the back of their recent, better-than-expected first-quarter sales and earnings, we're joined by the Chief Executive Officer. He's Bob Koncevitz. Bob, thank you, as always, for coming on Bloomberg to talk to us about trends and some of the things that you're seeing out there. It's pretty incredible when you look at what you've been reporting and of what you've been doing for Campari. You know, compared to your peers, you're seeing strong demand in the U.S. What's the difference between you and some of the rivals, and can that strong growth in the U.S. continue?
Well, first of all, our portfolio is skewed towards the hot category. So Kentucky bourbon, tequila, 100% agave tequila, and the aperitifs, which we obviously own, are really the hot categories right now. And within those categories, we have very, very strongly brands with great equity and momentum. And what you're seeing in the U.S. right now is a tale of places of consumption as well as target groups. Now, if you look at it, revenge conviviality is alive and doing well, but to a large extent, consumers have plateaued what they're having at home, or it's slightly down, and they're actually going out. And we've been traditionally always very strong in the on-premise in the U.S. market. Also, we target young urban professionals, which are not impacted by the current, let's say, macroeconomic challenges, whereas some of our peers, particularly those who are skewed towards cognac, they are being challenged because although cognac is a very premium category, the typical cognac consumer is blue collar, and that consumer is being challenged right now.
So, Bob, and I love the word, actually, revenge conviviality. This is, because people were pent up home, that they want to go out or host people, and maybe they buy more drinks. But does that mean that you can also, if you're trying to premiumize, does it mean that almost the sky's the limit in how much you can charge, or do you have to be much more careful in how much you put your prices up by?
Well, I think, pricing has increased because the industry has faced significant increases in input costs last year, particularly glass and alcohol, which are highly correlated to energy costs. So we've put through price increases. I think some categories probably exaggerated, namely the one I nominated earlier on, and they're bearing the consequences of it. Obviously, those brands which are more skewed to the on-premise are able to pass more pricing because there's less pricing elasticity there.
Bob, and you're wearing a beautiful Campari red tie, because I know you're also premiumizing some of the bottles, for example, for Aperol. But at what point does that translate into lower volumes? I don't know whether there's a model that you look at, or again, our consumer behavior is just changing because of what we lived through in the pandemic and how long that lasts for.
Look, it's a question of the value perception and the value equation in the consumer's mind. Last year in Europe, we've increased Campari prices between 15 and 25%. It was more of a price repositioning of the brand because the brand's image was there and the retail prices were here. So we had to get them up and close that gap. And frankly, we haven't lost any volume. A consumer recognizes quality and they're ready to pay for great brands.
We follow your acquisition trail quite closely. Last year, you bought a U.S. whiskey maker called Wilderness Trail. Is there any part of the market where you're targeting acquisitions as well, whether it's local or something like a bigger brand worldwide?
Last year, we actually did 5 acquisitions. We bought the French aperitif brand Picon. We've bought also the super premium Vermouth del Professore, as well as Wilderness Trail. And we're constantly looking at new opportunities. We're focusing on those categories where we are and looking for more premium brands and brands with an on-premise focus. If you can add to that from a geographical standpoint, a nice footprint in the U.S. as well as in Asia, bingo, that would be the best for us.
So what looks exciting right now, Bob, every time I go anywhere, I get offered either, a lower alcohol kind of cocktail or even a no alcohol cocktail. Is that where the world is heading?
The world right now, the consumer is heading in 2 directions. One is the high ABV classic cocktails. For example, the Negroni, which we own, is the #1 cocktail in premium bars, or the old-fashioned. And at the same time, they're going towards lighter cocktails with lower ABV, more refreshing type with bubbles. And that's where the likes of Aperol come in with Aperol Spritz or Campari with Campari Spritz. And in the non-alc side, we're actually doing very, very well with the non-alcoholic Italian aperitif Crodino, which is growing very strongly in international markets.
But we need to do a show where we talk about cocktails and how to make them. But very quickly, do you worry about the supply chain? So do you have to be more local as the world is fragmenting?
Well, in the world of spirits, origin is very, very important. To be called a Scotch, you need to be distilled in Scotland, to be called a Kentucky bourbon in Kentucky. And we also insist on having our aperitifs being produced in Italy. So I'm afraid, that's going to stay for a long time. Potentially, down the road, we could, send out concentrates and bottle them in other markets. But at the moment in time, we're really insisting on the authenticity of the origin.
Thank you. Bob, as always, thank you so much. The Campari Chief Executive, Bob Kunze-Konzowitz. This is Bloomberg.
Do you think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising New York City?
The mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Was going to keep rate World Cup. This is a 3 as the economic picture does.
The BOK is getting ready to make.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
In Big Ideas, we show the productivity increases that are possible
because of artificial intelligence, it's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. Now, on today's show, we look ahead to the coronation of King Charles and dig deeper into the monarch's finances. Now, in a moment, we'll speak to the chief executive who manages the largest of the royal investment entities, the Crown Estate. On last count, the firm manages £16.5 billion worth of assets with a net revenue profit of over £312 million. Now, since the death of Queen Elizabeth last September, the Crown Estate has a new owner, her son, King Charles. However, the estate, as it declares, is not the private property of the king. The royal family is funded via the sovereign grant, an annual lump sum derived from a 1760 agreement between the monarch and the UK government. Meanwhile, the Crown Estate, also profits and revenue, are deemed public money, which it pays to the Treasury. Now, over £15 billion of his assets line the property sector, notably the whole of Regent Street and St. James's Street in London. It also boasts 2.6 million square feet of redesigned office space in the nation's capital. Now, the Crown Estate also focuses heavily on renewable energy. It holds the right, for example, to virtually all the seabed surrounding the UK out to about 12 nautical miles. Well, the Crown Estate says UK offshore wind farms have produced 45 terawatt hours of electricity last year, making the UK the world's second biggest offshore wind generator. Now, on Saturday morning, the King Charles III will leave Buckingham Palace in a 6-horse-drawn carriage en route to Westminster Abbey. The route will pass key properties associated with the royal family that has an overall market value of more than £2.3 billion. Alex Morgan reports.
So go on then, how much do you think Buckingham Palace is worth? More than £1 billion. And that's just the start of the unique collection of assets that underpins the British monarchy. The route King Charles will take to his coronation is just over a mile long, but that mile gives a snapshot of the monarchy's billions. As the King's coach heads down the Mall, on his left he'll be able to see these cream-coloured mansions. Now that's Carlton House Terrace. They've got marble staircases, ballrooms and a view over St James's Park, which is literally there. Now that makes them some of the most desirable homes in the city, and many of those super prime buildings are the property of the monarchy through the Crown Estate. As the King makes his way through Trafalgar Square, if he were to crane his neck up the Strand, he could probably see the Art Deco offices next to the 5-star Savoy Hotel. Now those also support his royal fortune through the Duchy of Lancaster. The Crown Estate and the Duchy of Lancaster are the two main entities that fund the British monarch. These estates oversee total assets of about £17 billion. But here's the quirk. The King doesn't actually own any of these assets, not in the way you and I might use the term. Here's why.
Think about the Pope and the Vatican. The Pope does not own that personally. In the same way, King Charles does not personally own Buckingham Palace. He cannot put it on the market. These assets are held in trust effectively for the UK monarch and his successors over generations.
So while the crown jewels can't go up for sale, there are some serious perks to being king. For one, the monarch pays no inheritance tax on anything received from their predecessor. That's helped to preserve the Windsor's personal family fortune.
He is, through the personal assets that he has, through Balmoral and Sandringham Estate, and the land holdings, significant land holdings around them, he is a very wealthy man. We estimate at least $800 million for his personal wealth.
So given that sizable nest egg, when King Charles comes back to Buckingham Palace after the coronation, it'll probably feel quite irrelevant whether he actually owns it or not.
That was Alex Morgan breaking down the coronation procession route of King Charles and the wealth attached to it. Now here with me, Bloomberg's Ben Staples. Ben, thank you for joining us. I mean, you're looking at the wealth of the king and exactly what we can expect going forward. So what can we see along King Charles's procession route?
I think, as we saw in that report just there, Francine, Carlton House Terrace really is one of the ultra-prime residences properties in the world. So actually, in the past, the Crown Estate has sold some of them in the past to billionaire families, including the Hindujas from India. They've refurbished it, spent more than 100 million in total to acquire and refurbish that. So we see Carlton House Terrace. We also see part of the some of the crown jewels in the royal property portfolio. They're not part of the Crown Estate, but of course we'll see Buckingham Palace, but also St James's Place, and also maybe Clarence House. We might catch a spot of that. And right just before he turns to Whitehall, as we heard in that report, he might see some of the assets held on the Strand. And that's an important part of the private sort of piggy bank for the king, part of the Duchy of Lancaster estate. Just on the Strand, there are quite a lot of assets down there too. So all around where he's going to be walking on Saturday, the king is going to be surrounded by his riches.
Thank you so much, Ben Staples, our Bloomberg's wealth reporter. I mean, it is quite an amazing and in times controversial procession that we could see. Now, joining us now is Dan Labad, Chief Executive of the Crown Estate. Dan, we're really excited to have you on because not many people know what the Crown Estate do. So we laid it out in terms of, where the money goes. Do you have to manage this differently to basically a private company if it were on the FTSE?
Yeah, well, first of all, it's important to say that we're very unique.
Yes, you are.
But we are set up independently under an Act of Parliament, the 1961 Crown Estate Act, and our role is very simple. We have to create value for the country, for the taxpayer. We do that in a number of ways. One is obviously delivering 100% of our revenue to the Treasury. And in addition, thinking about some of the long-term national needs, for example, how we tackle climate change and energy security, how we think about the environment generally in the natural world, and thirdly, how we think about economic growth, something that is really, really important at the moment with families suffering and what's going on in the country.
And we know that, of course, the king has always, from a very young age, taken a very keen interest and cares deeply about sustainability. Is that why it's one of your mandates, or this was just in bed because of your closeness to basically Treasury and the fact that you need to make money, but also maybe want to do some good?
Yeah, we act and operate independently. We have to under our remit, under the Act. So the royal household has no day-to-day involvement with the business. And the things that we're talking about are things that are obviously, in the national interest. Now, clearly, being involved in things like climate change and the environment is something that, the royal household is very interested in and supportive of what we do as a result. But we are independent and we operate day-to-day under our own remit.
So you own a lot of the central London property. What's the outlook for that market like?
Well, it's important, I guess, for your viewers to understand a little bit more than central London. And I'll come back to that, but we also have a large land holding across the country in terms of opportunity for economic growth that we utilise. Where a large...
This is what, regeneration?
Regeneration, looking at another area that I'll get to in a moment with the seabed and how we make sure that, the benefits of the seabed come back on shore. We're one of the largest rural landowners in the country. In fact, one of the largest food producers. So the relationship...
You're everywhere.
Yeah, I guess this is the point. And marine is obviously the last, and obviously offshore renewables is a huge part of our future and a huge UK success story that we haven't been the only party to, but we are fundamental in making that the success it needs to be. I think, coming back, what's important is that 100 years ago, our remit was to create value for the country. And we used our land holding back then in a very different way to the way we're using it today, because things like climate change and the environment weren't as prevalent. And in 100 years from now, who knows what the challenges are going to be. And that's the exciting thing about the Crown Estate. It's a company for the country. And my role as Chief Executive and our team's role is to ensure that we're setting it up for the future so we can continue to do that.
So if we break down, we'll get to the seabed in a second, we'll maybe talk about regeneration, but central London property is one of the hot topics that we try and figure out whether it goes up or down, whether you see challenges and what your tenants are telling you.
Yeah, so clearly coming off the back of COVID and the digital disruption we started to see before COVID, property is full of challenge, interest rates and a whole host of other factors. One of the good things that we're seeing post-COVID is footfall returning to pre-COVID levels. We've put a lot of effort into, because we're contiguous owners, as in we own, a single large piece of real estate. We can think about the spaces between the buildings, not just the buildings themselves. And that goes a long way to ensure that we're getting people onto the streets, which was one of our concerns during COVID. Are we going to be able to make that happen again? Well, that is happening. And now talking to our customers, residential, commercial and retail, and looking at how they're changing.
So does that mean that you're changing with them? And
Yes.
Actually, so the trend is what, working more from home? Does it change forever the way that we use and shop in central London?
Well, I think, anyone sort of giving an absolute prediction on where that'll end up, I'd love to have that crystal ball. But I think what we do know, it's changing. I think, and we think that, London is long-term going to be very prosperous and continue to be. But as you say, I think the dynamics will change, how we activate the streets. And we're seeing that from our customers now. Different type of retailers, for example, are interested in Regent Street than were 5 years ago. Offices are still prime office space is still incredibly attractive. The challenge at the moment is, can we produce enough of it? And can we produce enough of it in a way that customers want, decarbonised and things that are, of the day?
And Dan, I mean, one of the things that, a lot of business leaders certainly stood up and listened to was a Burberry chairman last week telling Rishi Sunak, look, the retailing environment in the UK is very difficult because of the VAT and the fact that they're not giving foreigners a chance to come in. Is things like that things that you think about and lobby the government for because it makes a difference, or do you stay away from this?
We focus on what will work for our customers.
Right.
That's our focus. And because the challenge at the moment is everyone trying to work out what good looks like, our focus is keeping up what good looks like for our customers.
Talk to me a little bit about the seabed. And this is, in our research, it's amazing. We had a map saying how much you own in the 15 nautical miles. How will that change as I guess, the energy transition accelerates?
Yeah, so I think the seabed, first of all, is a huge UK success story, as I was saying. 25 years, second only to China in terms of market size, one of the most attractive places to invest in the world. Future jobs, which is incredibly important, and it's changing for a number of ways. It's becoming busier generally. There's navigation, there's defence, there's fishing, there's the environment, to name just a few. And on top of that now, the importance of the rollout of renewables. And one of the things that's incredibly important is that we're not going to achieve our net zero targets as a country if we don't utilise the seabed. But we have to do it in a way we're embracing different technologies. Wind's one technology that is up and running at the moment, but we have to think about carbon capture and storage. We have to think about hydrogen. And we have to think about, in that context, how we protect the seabed from a natural perspective. Incredibly important.
You're really at the forefront of every question that we ask all of our chief executives. Do you worry about AI? Do you worry about retraining? Like, if you're going to create jobs in these new technologies, whose job is it to make sure that you find the right staff with the right qualifications? Yeah, so I think we are concerned about skills levels in the future. And one of the things that we've done recently in the area of heritage and decarbonising is working with partners in London, other businesses and government, on how we think about bringing those skills in. So coming back to your question about, who's responsible, I think it's all our responsibility. It won't just happen. We have to all work towards. But I think, first of all, our role is to make sure we're creating the demand so that we have the pull factor, which I think offshore renewables is a key part of. And then as part of that, we have to ensure that the jobs are coming to the UK and that we have the skills deployed to deliver. Because your remit is so large, and again, it's also intrinsically tied to, the UK citizens, what do you think your hardest part of your job is? I think the hardest part of my job is to help people understand how important the Crown Estate is to the country. It is incredibly important. It serves national interests both for today. We've delivered £3 billion of returns to Treasury over the last 10 years. We're going to be doing more moving forward. But even more importantly, making sure that we're tackling some of these national challenges and doing it in a way that we just get more impactful and better at doing it as we go. Are you like a sovereign wealth fund, but with physical assets only in the UK? Is that how, we're trying to help a lot of our viewers understand? How do you see yourself? I think we're like a sovereign wealth fund or sovereign wealth funds, so insofar as sovereign wealth funds create value for the countries they represent. But I think it's important to just reinforce that we are unique. We sit between the private and public sector under this parliamentary remit to serve the country. So I think, in creating value for the country, yes, but that's probably where the similarities end. It's also the coronation 2 days, so I can't not ask you about that. Does it change? Do you have special celebrations in the Crown Estate, or is it just something that's, left to the organisers and the royals?
Well, we think obviously the celebrations over the weekends are great for the country, but you know, our people every day get out of bed and come work for the Crown Estate to create value for the country.
Okay. Dan, thank you so much. Great pleasure to speak to you. Dan Labbat, there, Chief Executive of the Crown Estate. And we're also getting some breaking news, PMI out of the UK. This is for April. It services, so it is a little bit backward looking, but still interesting. That PMI coming in a touch better than expected. 55.9, preliminary figure was 54.9. A reminder, anything above 50 is an expansion territory. Coming up, the King's coronation holiday could produce the latest drag to the UK economy, so we'll discuss that next as well. This is Bloomberg.
The tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Added the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Information you want, analysis you trust, everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg.
So what are the economic implications for the UK of King Charles's coronation? This Monday's extra bank holiday could prove a drag on growth. It will be the second time in a year that royal events have weighed on the economy. Now, Ana Andrade from Bloomberg Economics joins us. Anna, so how big, first of all, good morning, how big of a drag will we see from the holiday on the UK economy?
Good morning. So we are actually expecting GDP to contract in May by 0.7% on the month. That's a fall that's similar in magnitude to the ones that we've experienced in the extra bank holidays last year. But I would say that the key thing to note is that, you know, it's just a temporary drag on the economy. All the output that it's not produced in a given month will be regained in the following month. So overall, it's not a permanent hit. And the bigger picture really is that, you know, the economy is doing much better than we thought at the start of the year, even with the extra bank holidays and with the industrial action introducing volatility into GDP data.
So what does that mean for the Bank of England going forward?
Well, I mean, the holiday, they will kind of probably, you know, overlook it just because it's a temporary hit. But I would say the stronger economy overall is something that the BOE will consider next week. Although I would say that it's kind of, you know, the surprises that we saw last month in CPI and wage data, that's really what's going to move the dial on the BOE. They had given as a framework at the start of the year that they said that they were going to be very data dependent, and data on that front has only surprised to the upside, giving very little option for the BOE, but to hike next week.
So, and I mean, we're in this really kind of funny way where there's cost of living crisis, inflation seems to be higher than other parts of the Eurozone, but also growth is better. Is there, I mean, does this come all to a head at some point?
Well, I mean, I would just say that growth is better. It's holding up better for now.
Yeah.
But if you look a bit further ahead in the second half of the year, there's not a lot of growth happening there, because we expect tighter monetary policy to weigh on the economy. And I think, I mean, the big risk for the UK outlook right now is that if the Bank of England is forced to take rates higher, as it seems to be, then we can have kind of a monetary policy induced recession.
Yeah, and I guess it all depends on the credit crunch that we could or couldn't see. Are consumers holding up okay for the moment?
Yeah, I would say so. I mean, we saw a lot of credit tightening at the end of last year, and I would say that we'll have to see in the UK at least. It seems that the recent banking turmoil that we've seen, it hasn't had as much impact as it has on the US. So yesterday the Fed, maybe managed to signal a pause, a future pause, because the credit is doing a lot of the heavy lifting. And here in UK, we just haven't had that on the back of the banking turmoil yet.
Anna, thank you so much for coming on. And I would urge everyone really to look at a lot of what we do on Bloomberg Economics, some great research, Anna Andrade and her team. Now, coming up, we'll talk about In the City podcast with my co-host, Dave Merritt. Always fun, never dull. He joins me next. This is Bloomberg.
ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
Are we underpricing here in Europe, and just how far the ECB could still go?
We really haven't seen an impact from the hiking cycle on inflation yet.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference. Coverage begins Thursday on Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, joining us now, Dave Merritt, my co-host on our weekly podcast, In the City. Dave and I have been doing this for about just over 6 months, a little bit, maybe more than 6 months. And Dave, we've had fun because we're trying to unpick the UK economy, but through like fun conversations with leaders in their field.
That's right. It's a bit weird, isn't it, sitting at these podiums rather than with our headsets on and our
in like
mics in the podcast
dark
studio
little room.
that's just over there. But the idea for this was to kind of bring the listener into the room, you know, in our big newsroom here, sitting at the heart of the City of London, Queen Victoria Street, over the road from the Bank of England. The conversations happening here, but also in the square mile around us, kind of shining a bit of a light on the issues and what it tells you about the British economy, about the markets, and about the world as well.
So what surprised you? I mean, we've had some really good conversations. I know, you know, we spoke to Nick Candy, who really said some terrible things about London, and he's moving to Dubai because he can't stand
because of the crime, he said. I mean, that was an episode that went really viral last week. He said Dubai is having its moment, that London's kind of over. Everyone piled in on social media to say he's completely wrong. And that for me has been the surprising thing. You know, it's been so much turmoil, hasn't there, in the British economy ever since, I suppose, since the Brexit vote in 2016. But all the people we get in week after week keep coming back to the fact that London is where these conversations matter the most, that London remains the sort of beating heart of the markets across Europe and for investors all around the world.
I wonder whether, and I don't know whether you have this feeling in some, and also shout out to our great producer, Summer, who puts it all together and makes us fun, which is not always an easy feat. No, I'm kidding.
It's a tough edit, I think.
It is a tough edit, but it's basically trying to understand if it's a crunch point where, you know, the City of London could go either way. They could either win this or give its crown to New York.
Yeah, we wanted to go on the road to Paris, didn't we? Because, you know, Paris is definitely on the up in terms of a financial centre in Europe. But, you know, time and again, you come back to the fact that the scale of the infrastructure in London, that the talent, that the numbers of people here, it really does outshine everywhere else. I think Alex Brazier, who we spoke to this week, that's the episode out today, from BlackRock, formerly of the Bank of England, you know, he talks about how we're at this inflection point in the global economy and actually how London is poised to really benefit. We're seeing the return of volatility, interest rates staying higher for longer. That's an opportunity for investors, and he thinks London's really well served to really benefit from that.
Yeah, and one of my favorite episodes was also with the legal and general chief executive, and he told us at the time that he was offered, you know, a big job at Apple, and then decided not to take it, and that kind of changed the course. And he's of course also really quite close to the king.
That's right, Nigel Wilson. I think the mic was off when he told us his king anecdote, wasn't it? I don't think
it was, but I mean, people open up, right? And it's very clear that their businessmen and chief executives are quite close to the king because of his sustainability efforts.
That's right, you know, and it's a different sort of regime, right, than before, and obviously with the environmental crusading that King Charles has been a part of, he was very much ahead of his time, and that's something we've explored in the podcast.
Coronation plans?
Oh, well, obviously, you know, get the bunting out, have a go at making the coronation quiche, presumably, you know.
I'm in charge of the G&T bar for this.
Right, the drinks, obviously,
Help everyone. David, thank you so much. My co-host, Dave Merritt, and we have a new episode out today. Subscribe, rate, review the In the City podcast. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists, because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient.
These stresses in the banking sector are likely still there. They're likely still coming. They're likely still tightening financial conditions as we look ahead.
They're trying very hard to separate financial stability concerns, banking system concerns from monetary policy.
They created part of the stress on the banking system that arose when they had to tighten monetary policy by 5% in a little over a year. So the Federal Reserve has some culpability here.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Another U.S. regional bank is raising concerns about the sector's health. PacWest moves to calm the market after shares plunged 60% after hours. The Fed's latest interest rate hike may be the last one in the cycle. Fed Chair Jerome Powell opened the door for the central bank to pause next month after 10 increases. Today, it's the European Central Bank's turn. It's set to slow the interest rate hikes after its preferred measure of inflation eased. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And yet again, another reminder coming after the Fed this time of the tensions around the regional banking sector, Matt. But interesting to see that, yes, Fed futures stock futures, equity futures in the US are not gaining a great deal, but they're also not falling over substantially as a result of this latest round of nervousness.
Yeah, absolutely. And we didn't fall terribly yesterday. We were down about 0.7% in the cash trade on the S&P 500. And as you say, we're unchanged right now, even with, a 60% drop in PacWest. Renewed concerns about regional bank viability. Take a look at the S&P future. Well, they're exactly unchanged right now. So the 10-year yield, I think, is interesting, coming up a little bit, but from such a low level. 2 days ago, we were looking at 355, and now we're looking at 336.36. So a drop of almost 20 basis points. NYMEX crude also right now doesn't look as interesting as it did last night. We saw a 63 handle on NYMEX crude around 8 p.m. yesterday. So it dropped dramatically, and it's recovered a bit since then, but still under $70 a barrel for WTI, and I think we see Brent around $73. Interesting that Bitcoin has rallied so much, up back above $29,000, adding 585 to 29,114. So the drop that we had yesterday, it was also in tech shares, right? The NASDAQ also fell a little bit less than 1%, yet Bitcoin continues to rise. Take a look at what's going on in Asia. You do have big gains in Asia overnight, certainly in Hong Kong, and maybe that's one of the reasons that Bitcoin was able to gain. It does do better in the Asian session. The broader MSCI Asia Pacific Index up only about 0.5%, but the Hang Seng up 1.25%. The Nikkei closing up just 0.1%. So the action in Tokyo, not so dramatic. You do see a little bit of U.S. dollar weakness against the yen. You can now only buy 134.67 yen for a dollar. Anna?
Let's have a look at what's happening in Europe. So this is the European equity market picture, Matt, and really catching up with the in-session moves on the Fed yesterday and also pricing in some of the European earnings stories that we've been dealing with this morning. Yesterday, of course, European markets closed before we got the Fed statement. So that sell-off on Wall Street post the Fed, we had to factor that in to our markets. And so European markets are a little on the back foot. We've got some big heavyweight ex-dividends affecting the some measurements, of course, of these markets. But that's broadly what we see, a little bit of nervousness in the markets. Brent crude is up by 1.3%. To answer your question about where Brent is right now, Matt, you're right, it has a 73 handle. And to your point, bear in mind, we started the week at $80, above $80 at one point on Monday. So in not many days, we have lost quite a lot on Brent crude, even though we bounced 1.3% this morning. And that's despite this concerns around maybe the US economy, maybe the Chinese economy, despite the fact that some really interesting seaborne data showing on the Bloomberg terminal that more oil is heading to China by sea than has been the case over the past 2 years. So that's really interesting to keep an eye on. Sticking with the energy theme, Shell is up by just over 2%, better than expected numbers, sticking with the trajectory of their buyback, and that's better than we heard from BP, so that stock is rewarded. BMW also beating analyst estimates, and there's a buyback there in the mix as well. They didn't guide higher, that disappointed some, but still the stock is up by nearly 2%. And just checking in, it is ECB day now, Matt. No time to linger too much on what we heard yesterday. We're onto the ECB, and 110 is where we trade right now, down by 0.2%. We've had some data out on the services side, 56, the handle on the services side for the PMIs across the Eurozone, which is, of course, well into expansion territory.
All right, so watching European automakers and watching especially closely the ECB. We'll continue to cover that. But let's get to the regional banks here in the U.S. A new focal point of investor concern about the health of U.S. regional banks. PacWest shed more than half of its value in after-hours trading after Bloomberg reported the bank is considering strategic options, including a sale. By the way, that sell-off continues this morning in the pre-market. It kicked off just after Fed Chairman Jerome Powell said authorities were closer to containing the turmoil that's claimed 4 lenders so far this year.
There were 3 large banks, really, from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress.
As Powell tries to reassure investors the banking system is sound, Pershing Square's Bill Ackman warns that there are still risks, writing in a tweet, quote, "We are running out of time to fix this problem. We need a system-wide deposit guarantee regime now." Michael Moore, Bloomberg finance editor, joins us now to explain what's happening and what options PacWest might have. Michael?
Yeah, so PacWest had said before they were looking at potential asset sales. We've reported that they're perhaps even considering things bigger than that, a sale of the whole company. They did come out with a statement confirming that they are talking to potential partners, potential investors about a range of options. Also said that their core deposits are up since the end of March. So trying to calm markets down a little bit. You know, one thing to note that PacWest is a fifth of the size of First Republic or SVB, so much smaller bank than those ones that ran into trouble. So, you know, as this turmoil continues to not be contained, better go down than up.
Okay, yes, and we keep hearing from the likes of, Jerome Powell telling us and Jamie Dimon telling us that they think the worst may be over, or we're trying to draw in a line in the sand. I mean, do we get a sense, the fact that we can have a 60% drop after hours in one of these regional banks, Michael, and yet the futures picture, yes, it looks sluggish, but it doesn't dominate sentiment.
Right.
Is that a positive?
I think so, and I think it's because you're seeing it go to these smaller banks and not, you know, up the chain to some of the bigger banks, which seem quite in good position right now. If you did have, you know, a sale, like there's a number of banks that could take a bank the size of PacWest on. So I think that's reassuring people. And PacWest did say, you know, they have more than enough liquidity to cover all the uninsured depositors that they have, but they haven't seen significant outflows.
All right, Michael, thanks very much. Bloomberg's Michael Moore covers the banks for us out of London. Now, here in the U.S., the Fed has hiked rates by 25 basis points and hinted it may have been the last move of the tightening cycle. But Chair Jerome Powell stopped short of declaring victory in the battle against inflation, quite the opposite. Former Atlanta Fed President Dennis Lockhart spoke with Bloomberg after the decision.
The focus is on inflation. They're trying very hard to separate financial stability concerns, banking system concerns from monetary policy. We'll see if conditions force them to begin to combine financial stability concerns with monetary policy decisions. As of today, they did not do that, and they don't appear to believe they have to do that.
Bloomberg's Valerie Teitel joins us now for more. So, Valerie, were there any surprises, any curveballs from Powell?
He kept it fairly boring. Even in the Q&A, there really wasn't a lot of market price action around what he said. He did what the market expected to do, and he signaled for a pause, saying we no longer anticipating further rate increases. But he went on to talk about, when he was asked about whether they've reached a sufficiently restrictive level, he said we need a few months of data before he can declare that. He's clearly trying to communicate that even if they do pause in June, another hot inflation print in a month's or 2 months' time could cause them to hike again. And that asymmetry in the front-end pricing is what he wanted to achieve. I think he got away with it. He also ended on talking about the banking turmoil, saying that it's resulted in even tighter credit conditions, but he was asked more on this in the Q&A, and he didn't necessarily paint a dire picture. Remember, when it comes to banking conditions, lending conditions especially, the Fed knows a bit more than the market does. So the fact that he didn't necessarily paint this dire picture gives the market maybe a bit more confidence that on Monday, when we get the senior loan officer opinion survey, it won't be as bad as feared.
And just as you told us there would be, Valerie, there was a change to the statement in paragraph 3. So I was definitely focused on the right things yesterday, thanks to your briefing. Let's pivot from that part of the Fed narrative to something else, because lest we forget, there were actually some open roles, open positions at the Fed that Biden needed to fill, and we've got some news on that.
Yeah, we do. Bloomberg was reporting that Biden is likely to pick the Fed's Jefferson for the vice chair seat, and that nomination can come as soon as Friday. He then goes to the Senate to be confirmed, so the process is still not over. I think, though, the most important thing that has come out of this musical chairs at the Fed was a story that the Wall Street Journal put out over the weekend, signaling that the reason why this Uber dove, Lael Brainerd, left her vice chair seat was because she felt she couldn't be as vocal in that seat. She couldn't be seen as dissenting versus Powell because we know she's a dove. She was fighting against those further rate increases. So she's gone now to the White House. Maybe that's a signal that the political winds, the political forces on the Fed might be changing soon, as maybe more of the White House will be clamoring out for rate cuts.
All right, Valerie, thanks very much. Bloomberg's Valerie Teitel talking to us about the Fed decision yesterday. Let's turn our attention now to the European Central Bank decision, which comes out in just 3 hours' time. Bloomberg's Maria Tadeo is on the ground in Frankfurt outside the ECB. So, Maria, we are expecting a hike, but is it 25 or 50?
And for once, it's sunny out here. I'm not sure if that's an omen either way, but it's convenient for me nonetheless. Look, Matt, when you look at that decision, yes, it is understood the European Central Bank will hike again, and how can they not when you see headline inflation still moving around the 7%? Remember, their goal is close but below 2%. Now, the question very much in play is at 25, is at 50 basis points. Now, overall, some suggest Deutsche Bank has a note still saying it is a close call, because you can look at data and flip it both ways. Nonetheless, the call that carries some of the bigger momentum going into the meeting is at 25 basis points. When you look at core inflation, which again, this is not the target, but we know because the European Central Bank has made it very clear, very explicit, this is the kind of dynamics and data that they pay attention to, cooled in April. When you look at the lending survey, you did see that credit standards actually tightened too, and you're seeing this turmoil still play out in the banking sector, which, remember, the European Central Bank also said it would monitor in terms of the implications that it would have for European banks and therefore the European economy. So again, there is some suspense, I guess you could say, but obviously we're waiting for Madame Lagarde to make this official. Nothing is official until she speaks.
Okay, so it's that debate around 25 or 50, market leaning towards 25, as you say, Maria. What else are we going to be watching for then in terms of the decision-making and the communication today?
Yeah, and again, the market very much leaning to that 25 basis points, which is important because if you look at how decision making is going on here at the ECB, it is very clear that this is a twofold decision. It's not just a rate move. When they hike softer, there is an implication that they will have to signal an acceleration on the QT. Remember, these are 20 central banks that have to agree on monetary policy. So to get to a consensus, a large majority, you have to give something to both camps. So I would also watch out for the implications for QT. When it comes to the press conference, especially on a day like today, there will be questions about the Fed and the fall through that could have potentially on the European Central Bank. The idea of banking turmoil increasing, maybe also too in the euro area. There's a spillover effect from it. And then again, it'll be interesting to see whether she hints that the direction of travel is not going to change, that this is going to be a central bank very focused on data, very focused on core inflation, the transmission, and also take it now on a meeting-to-meeting basis, which then takes us to June.
All right, Maria, thanks very much. Bloomberg's Maria Tadeo outside the ECB in Frankfurt. Stay with Bloomberg for full coverage of the ECB decision. It's due out at 8:15, and then, of course, Christine Lagarde, her news conference follows that. Now, let's get a look at some of the stocks that are moving in the pre-market this morning, other than the regional banks. SolarEdge Technologies is one. This company gaining after Q1 profit and revenue topped estimates. The outlook for Q2 was in line with estimates, and investors like that. The shares are up more than 11%. Also, Confluent shares, an application software company, those are up after first quarter results beat estimates, and the company affirmed its forecasts. The shares up about 6% in the pre-market this morning. Qualcomm is a company that's down this morning. The chipmaker gave a third quarter forecast weaker than expected. Analysts say the guidance shows that weakness in the smartphone market, which is where Qualcomm is so active with its chips, will persist until September. What happens in September? A new iPhone comes out. Qualcomm shares down 6.6% in the pre-market. And then speaking of iPhone, we're all waiting for Apple. It reports after the bell today, and Wall Street is bracing for the second sales decline in a row as the company battles a spending slump. We're looking for roughly 5% drop in revenue from a year earlier. Analysts believe that all of the company's major product categories, including the iPhone, will suffer sales decreases. That's despite an improvement in the supply chain, so you can get them if you want them, but people just aren't out there buying them at the numbers that analysts would like to see. Anna?
When we come back then, Matt, we will talk about the global economy. We'll be joined by Chris Watling, Longview Economics CEO and Chief Market Strategist, to get the market perspective. We'll also talk to Simon French, Pam Muir-Gordon, Chief Economist. How does he weigh up what we heard from the Fed and look ahead to the ECB? Plus, investors are assessing a slew of earnings for clues on the state of the economy. Earlier today, I spoke with Vincent Clerc, the CEO of the shipping giant Maersk. The company saw profits slump in the first quarter as global trade slowed.
I think after the last couple of years that have been highly unusual with bumper profits across the whole industry and a lot of supply chain disruptions, we were expecting actually that this would normalize. This started already into last year and continued into this quarter. So as we see this normalization, we're going to see also a normalization of prices and a normalization of revenues as a consequence.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York with Anna Edwards in London, and we're there. I have a chart here that shows what the market is pricing as far as the Fed's terminal rate, the highest level it'll get to in this cycle, and that's the white line. In yellow, you can see the Fed's consistent rate hikes. That's the federal funds target rate. The two have finally met. And the question is, do they stop now? Joining us is Bloomberg's markets reporter, Justina Lee. I think it's consensus that this is it, right? Justina, we hold. Obviously, they're data dependent, as always. But the next move will more likely be a cut than a hike.
Yeah, it's pretty obvious that markets had a very dovish takeaway from the Fed meeting yesterday, even though by some accounts, nothing really changed. And I think that's because markets have already shifted the focus to the regional banking crisis. And what they're expecting is, tighter lending conditions, as, Fed Chair Jay Powell flagged himself, and that should help take care of inflation.
Okay, that's really interesting. The role that banks play in this is interesting, isn't it, Justina? I mean, we got some clues, didn't we, as you say, from Jerome Powell about that lending data and what that's going to look like. We thought we'd have to wait till next week, but it seemed as if he gave us a few clues around that. It is something that the Fed is watching, and that would bring their sort of financial stability concerns into the same room, perhaps, as their monetary policy concerns, if we're seeing the tightening in financial conditions because banks are pulling back.
Right, exactly. I mean, the backdrop to the Fed meeting yesterday is that we've seen this really dramatic plunge in banking stocks this week. And it's been pretty surprising given that we already had a solution to First Republic Bank over the weekend, and Jamie Dimon was out saying that the banking system is fine. But clearly that, markets are not consoled at all. And I think what investors have shifted their focus on is the fact that if banks are going to tighten lending conditions, that does make a recession ever more likely. And so a rate cut is still on the table, even though I would say Jay Powell kind of was careful not to encourage that narrative yesterday.
Yeah, he was not encouraging it, but it didn't stop the markets pricing it in, did it? Justina, thank you very much. Bloomberg's Justina Lee with the latest on post-Fed market reaction. And for more market analysis, check out MLIV Go on the Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
Access the financial world on demand.
Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Atlanta, police have arrested the suspect in a fatal shooting at a medical building after a manhunt that lasted several hours. They say he stole a vehicle after the attack and then later fled on foot. One person was killed and 4 others wounded. The suspect's sister says her brother was not mentally stable. In China, the economic recovery is showing more signs of imbalance. A new report points to a drop in manufacturing activity for the first time since January. Meanwhile, a surge in travel over the 5-day Labor Day holiday fueled consumer spending. And Bloomberg has learned that the European Union is discussing a new sanctions mechanism. It would target third countries that it believes aren't doing enough to prevent Russia from evading sanctions. The process would focus on those that can't explain spikes in trades of key products or technologies. And it's the biggest IPO in the U.S. since 2021. Johnson & Johnson's consumer health business, Kenvue, raised $3.8 billion in an upsized offering that values the company at more than $41 billion. Kenvue's products include household names such as Tylenol, Listerine, and Neutrogena. Coming up, Chris Watling, Longview Economics CEO. This is Bloomberg.
Most actors are thrilled if they have one part like Rocky in their whole career. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And he said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Another U.S. regional bank is raising concerns about the sector's health. PacWest moves to calm the market after shares plunged 60% after hours. The Fed's latest interest rate hike may be the last one in this cycle. Fed Chair Jerome Powell opened the door for the central bank to pause next month after 10 increases. Today is the European Central Bank's turn. It's set to slow the interest rate hikes after its preferred measure of inflation eased. I'm Anna Edwards in London with Matt Miller over in New York. And Matt, we're dealing with everything today. We've got earnings stories. We've got regional bank tension over in the United States. We've got the aftermath of the Fed, and we work our way towards the ECB.
Yeah, a lot going on today, but it's not moving markets that much at all, at least in terms of the benchmark index futures right now. S&P E-minis are basically unchanged. Take a look, even after the drop that we saw yesterday, about 0.7% in the cash trade. S&P futures not doing a lot. We also saw a drop in yields yesterday, pretty substantial drop. What we don't see much of a bounce back. 336.93 is your level on the 10-year Treasury, and that's up less than 3.5 basis points. We don't see a lot of movement in today's session for crude either, although a big bounce back from the lows that we saw yesterday. At the end of the session, NYMEX WTI crude dropped down to a 63 handle. We've now bounced back to a 69.18, so still under $70 a barrel, but it was a pretty dramatic move yesterday, and it's clear that OPEC, their surprise cut, hasn't done much to uphold the price of crude. Bitcoin has seen a dramatic move. Now, this may be due to the rise we saw in Asian markets. Some Asian markets did really well overnight, including the Hang Seng Index, which was up about 1.7%. As a result, Bitcoin is gaining another $544 today, over 29,000 at 29,073. So just. In terms of the regional banks that we're watching so closely, they cratered after the Fed decision yesterday and after the press conference. A few hours later, we saw PacWest down 60% in news that it would seek other options, including the possibility of a sale or raising capital, maybe a breakup. PacWest shares are now down only 37% from the close. But as I said, they were down at 60% at one point in the after-hours trade. Western Alliance is down 17% in the pre-market this morning. MCB is one Metropolitan Bank holding company that's been down with these others pretty substantially and remains with the losing pack, off 15% in the pre-market, and New Jersey-based Valley National Bancorp down about 6% in the pre-market this morning. There are a lot of other movers really in the tech space on earnings. Solar Edge Technologies, which makes equipment that helps you sort of squeeze more energy out of your existing solar technology is up 11% after it gained in profit and revenue in the first quarter. It gave an outlook for the second quarter that was in line with estimates, and analysts, or investors, I should say, liked that enough to bid it up 11%. Confluent is also up about 6% this morning after that company beat first quarter sales and profits. It also affirmed its forecast. So just leaving its forecast the same was enough for Confluent as well as SolarEdge. Qualcomm, on the other hand, fell after the chip maker gave a third quarter forecast that was weaker than expected. Analysts say the guidance shows weakness in the smartphone market will persist until September. As a result, Qualcomm down almost 7% in the pre-market, and we're watching Apple, speaking of the smartphone market, down 1.3%. We're expecting Apple earnings after the bell, and we're bracing for another sales decline in another iPhone sales decline. The company battling a spending slump and looking at a drop of about 5% year on year. In fact, all of the major product categories are expected to fall. So not just iPhones, but Macs as well as Apple Watches, etc. So watch this space. After 4 o'clock, we'll get Apple's earnings. Anna?
Okay, we'll certainly focus on that. Apple, no doubt, one of the big corporate stories of the day. Back here in Europe, then, we've got European equity markets actually worsening their losses a little bit, down by 0.7% right now, catching up with some of that post-Fed move on Wall Street yesterday because the Fed news came, the Fed conversation, pricing in of recession risks a little more maybe in markets. All of that happened after European markets had closed, and so as a result, maybe a little bit of catch-up to play there. Brent crude is up by 1.2%. Matt was talking about WTI. Well, Brent now with a $73 handle, and remember, at the start of this week, we were trading around $80 on Brent, so concerns again around recession in the US and around slowdown in China. Shell, sticking with the energy theme, that stock up by 1.8% this morning. The company beat estimates with its earnings for the first quarter. They're dealing, of course, with lower gas and oil prices compared to this time last year, but they managed to beat estimates, and so that went down well with investors, as did the fact that they stuck to their buyback plans, and that's not what we heard from BP. So as a result, Shell is rewarded. Euro dollar in focus today because it's ECB day, so just checking in there, we are at 110.49, down 0.1% for the euro as we head towards the ECB then, Matt.
All right, we'll continue to watch ECB, or expect the ECB to come out in less than 3 hours. Joining us now is Chris Watling, Longview Economics CEO and Chief Market Strategist, to talk to us about, well, first, I'd love your reaction to the Fed, Chris. Was that the last rate hike, and do we get a cut this year?
Yes and yes. I mean, I think what you saw with the regional banks' performance yesterday kind of says it all. Another rate hike and the idea that they're going to try and keep rates at high levels throughout the rest of this year is really bad news for a lot of these banks. And as you just talked about, a lot of the regional banks suffered significantly in trading after that announcement, after the Fed, and in after hours. So, you know, I think this banking crisis has got more legs to it, and therefore will be pretty soon to cut rates, would be my opinion. So the idea that we're going to stick with a hawkish pause, I think, as it's being characterized, is, I think, probably the triumph of hope over what will be reality.
Okay, good morning to you, Chris. I mean, those who see things differently would argue maybe that, you know, inflation is going to be difficult to get down. In particular, this last bit of inflation will be difficult to bring down, and that might get the Fed pausing for a long time, or possibly even thinking about hiking again, as we've seen some central banks have had to rethink their pause, of course. And they might also suggest that maybe this regional bank story goes back under the radar in the way that regional bank failures have been in years past. You don't see it that way, though.
Well, you never know. I mean, you can never say never. But I'd be extremely surprised if that happened. I mean, that's a whole lot of very good news coming all at once, if you like. No, I mean, just look at what money supply is doing, and people have been talking about this recently. M2 money supply is contracting quite fast now in the States. This is really troubling. And as I keep telling people, this hadn't happened any time any of us have been alive. You know, you've got to go back to the 1930s and before. And of course, the reason it's contracting is because of what's happening in the banking system. You know, because of the banking deposit flight. Most of M2 is bank deposits, you know, sort of 80% of it. So they contract together, and they both reflect tight money. So that's telling us, I think, that actually there's a growing risk of deflation. I wouldn't say that's your central case now, but it's emerging onto the sort of radar, and it's something markets are starting to think about. And this is a really critical issue. So will inflation stick around? No, I don't think it will. I think money supply is telling us it's going to go pretty fast. The recession is coming, and the bank problems haven't gone away. So I think they'll be cutting.
Okay, you think they'll be cutting. And how do we place stocks with that trajectory in mind then?
Yeah, I mean, if we're right about the recession, you don't want to be in stocks. I mean, the market's fascinating at the moment. If it's held up. The S&P's held up nicely for 6 weeks. It's been really dull, actually. It's just been 100-point trading range.
Hey, that was okay after March.
That was okay after March, maybe. I don't know. But you want a bit of volatility. But anyway, under the surface, things aren't so good. You know, oil, you mentioned, it's actually down 11% in 3 days. Maybe it's bounced a bit today, but 2-year bond yields are back down at low levels from mid-March. 10-year yields are on resistance, look like they want to go lower. The Russell 2000's almost at multi-month lows. The rest of the market, apart from the mega cap tech, is telling you a different message from what Apple's telling you. So, you know, it's been a narrow advance this year. That's not a good advance if you're a bull.
You know, I was reading Kevin Muir's piece, the macro tourist piece on how to trade after the last hike, and he points out that over the last, I think, 6 or 7 cycles that he chronicled, you do see a rise in stocks 2, 3 weeks, 4 weeks out. But you're looking a little bit longer, right? What are you waiting for to kick off this recession? Or what are you waiting for to go in and buy stocks? Where will we see the dip?
Well, I would say that was an interesting piece. I think I saw the same one. The last 6 examples are when the Fed peaked. Most of them you buy the market. You know, if it's a mini-cycle, mid-cycle slowdown, buy the market. If it's a recession, it's a completely different ballgame. And the problem with taking the last 6 hiking examples is only one of them includes a recession. If you look at every recession, when the Fed stops hiking, you sell the pants off stocks. You don't buy them. They're going to go down, and they're going to go down meaningfully. So, you know, I think a recession is coming. I don't want to buy these equity markets until I feel we're near the end of that recession and the Fed's cut a lot. Not just begun, not just paused, but actually done most of their rate hikes.
Is the ECB
so I think you've got to be careful.
Is the ECB in a different place, Chris? I mean, do you expect them to have to keep hiking to tame inflation? Or are we expecting the same kind of earnings recession out of Europe as we are expecting in the U.S.?
Well, as long as I've been doing this job, whenever the U.S. has a small recession or a large one, the Europeans have one that's worse. And I don't think this time's going to be any different. So I don't think they're in a different place. And famously, they always seem to hike into recessions. So I think they'll be stopping sometime soon as well.
Okay, Chris, thank you so much. Thanks for joining us. Chris Watling of Longview Economics with his perspective on the global economy and the markets. Next up, we'll get the perspective of Simon French. Pamela Gordon's chief economist joins us shortly. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
We also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio, live live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, the European Central Bank is poised to slow the pace of interest rate increases today. That's after its preferred measure of inflation eased for the first time in 10 months. Officials at the central bank are expected to raise the deposit rate by a quarter point to 3.25%. Joining us now is Simon French, Pramil Gordon, Chief Economist. Simon, really good to speak to you. And we'll start with the ECB, but then we'll probably get your thoughts on the Fed as well. So you're in Camp 25 today, as opposed to Camp 50. There are some people in Camp 50. Yeah. Why the 25? And I suppose more importantly, how long can the ECB keep hiking now if you think the Fed has paused?
Sure. So herd behavior. So central banks tend to move in a pack. And the fact that the Fed went with 25 basis points and I think quite importantly talked about the lags, the interpretation of the lags. I think that's very relevant to the ECB, who are obviously the last of the major central banks that have done a persistent hiking cycle to get going, and therefore they're least of the way through the lags. So to being able to interpret what the overall impact is on financial conditions, we have less information in the Eurozone than anywhere else, and therefore that heightened uncertainty on what the transmission is, I think is the reason why I'm in the 25 camp rather than the 50 camp.
And on the subject of how long the ECB keeps hiking for, Chris Watling of Longview and a number of other guests this week citing that old adage that when the US sneezes, the rest of the world catches a cold. Yep. Is the pause going to be contagious?
Right, some of the pricing is wrong on likelihood markets, because if you look at European and include the Bank of England and the ECB in this, they're looking at about markets expecting another 60 to 70 basis points of hikes into the year end. The market is seeing 80 to 90 basis points of cuts from the Federal Reserve. I can't, in my memory, Chris was talking before the break about his living memory of convergent monetary cycles. I can't imagine that those cycles will be allowed to play out in that way. But where I perhaps differ with Chris' interpretation is I'm not sure that the cycle necessarily is going to play out as the sort of following the US in terms of very weak consumer-led demand leading to a hiking cycle and risk of lending translating itself to Europe. I think more likely is those two likelihoods will converge closer in the middle with more of a plateauing, lower than the market expects in Europe, but rather less cutting than we're seeing seeing priced in the United States.
Simon, I continue to be surprised by how many people expect the Fed to cut rates this year. I mean, they've worked so hard to get up to 525 and to tighten monetary conditions in order to bring inflation back down closer to 2%. And I think they want to get closer than like 4. So what do you think, and what would make the Fed cut rates?
Well, I think you're right to be surprised, and I think you have to start talking about the credibility of what the FOMC and, of course, Chair Powell is saying, because, of course, he's been very persistent in telling the market to expect a persistent plateau. The market thinks it knows better how economic, financial conditions, monetary cycles evolve. Clearly, those of a monetarist bent, and again, we were talking before the break about M2 dynamics in the United States, maybe that is the leading indicator that the bond market is overweighting versus the central bank. But I think you're right. At the moment, the FOMC couldn't be clearer that it anticipates a persistent pause, but the market is not prepared to listen and thinks ultimately it knows better than the FOMC.
So, but what would cause the Fed to cut? I mean, is it that inflation comes down to 2? Will they cut then? If we get, an extra 1% of unemployment to 4.5, would they cut then? I just don't know what forces them to do that other than, some horrible economic tragedy in which you don't want to own risk assets anyway.
Exactly. I think it's more the latter. I think even if you saw headline, either PCE or CPI, trend to 2, I think the memory of this period and the degree to which excess demand began to fuel uncomfortable core inflation in the US economy means that that would not be the trigger to start a cutting cycle. I think it is if you see widespread evidence of demand destruction, and then that requires the type of issues we've seen in the regional banking sector start to translate themselves into a broad-based tightening of financial conditions. There are pockets of tightness in financial conditions, but a broad-based one at this stage, the type that would change the Fed's response function, I don't see that in the data as we sit here today.
Yes, and thinking of the data that we don't know yet but will know soon, Simon, we've got jobs data tomorrow. This is Friday, isn't it? Yeah, tomorrow.
Yes.
Inflation data next week. I mean, both of those data points, I suppose, have the potential to shake markets if markets have become increasingly convinced of a pause and then cuts later on this year.
Yeah, it might not have felt like it, but it was a rather easier interpretation of the central bank response function last year because they had quite explicit forward guidance, certainly got to there by the start of Q2 actually last year. Now in data dependency, yes, each print has an added level of resonance. And actually perhaps the surprising part thus far has been the relative stability of those key financial metrics in equity markets, bond markets, to the data prints we've had thus far. I do think that changes as we go through Q2 because of that spread in outcomes between the major economies, particularly Europe and the United States.
Yeah, okay, Simon, thank you very much. Simon French and Pamela Gordon joining us with his view on the global economy. Stay with Bloomberg for full coverage of the ECB's rate decision. That's due at 8:15 New York time, 1:15 p.m. here in London, followed by Christine Lagarde's news conference. She'll be in Frankfurt, of course, but giving you the times in London time there. Now, more on the markets coming up, more on the earnings stories coming up. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now we'll look at some of the things that are ahead for today. Earnings season continues. We've talked about some of the big names, with other names also featuring Peloton, Kellogg and Moderna among those reporting before the US market open. Over in Europe, it is decision day, of course, for the ECB. At 8:15 a.m., that's Eastern time, the central bank reveals its latest rate move, with President Christine Lagarde set to give a press conference half an hour later. At 8:30, we will get an update on the US labor market, with the latest initial jobless claims data setting the stage, of course, for Friday's non-farm payrolls. And after the bell, Coinbase and Apple both report their quarterly results. Apple, a subject that Matt has been focused on.
Yeah, I'm watching closely to see how they do in terms of iPhone sales. It could be a second consecutive quarter of drops. But I'm also watching very closely what happens with the car makers. After we had earnings from GM and Ford, now we're getting earnings from Volkswagen and BMW. For more, let's get over to Bloomberg's Oliver Crook. He's in Berlin. He's been covering the German car makers for us there. Oliver, let's start with VW. You know, by some measures, the largest car maker in the world. What were the takeaways there?
Yeah, so fairly strong quarter for VW there in the first quarter of the year. So you had sales up 22%. They beat estimates. You also had margins up, beating estimates. And strength really in the United States and in Europe. And again, helped by that huge backlog you have in Europe, 1.8 million cars that they're still working through to get off and onto the streets. But then you look at kind of the downside of this story. And in China, which as we all know is Volkswagen and every German automaker's biggest market, sales down 14.5%. And this is also in the quarter where BYD overtook Volkswagen for the first time in terms of unit sales. I spoke to the CFO a little bit earlier about their China strategy.
We develop in China for China to speed up the development. And last but not least, we introduced the ID.7. It's a great car. So with all these measures we have in place already, we are quite confident that we can play a leading role in China in the future.
And this quarter, the entire board went to China to the Shanghai Auto Show. They're really very cognizant of this problem. And really, they think the solution is going to be offering more and more cars to that market in China, including the ID.7 there that's behind him that you just saw. And I also asked them about the price war with Tesla. Are they really willing and ready to wage war with price war with Tesla on EVs? They said no, they really need to preserve their margins and to keep EVs kind of more like ICEs in terms of the money that they make.
Okay, so a focus on China there. The market unmoved, the VW share price not moving much. What about BMW? We've got numbers out from there as well. That stock price moving a little more. Tie it all together for us.
Yeah, so overnight you had a buyback announced from BMW as well, 2 billion euros there. And again, when you look at the regions for them, before we do that, let's talk about pricing. It's all been about pricing over this last year for the automakers, particularly the high-end ones. Here in Rolls-Royce and the 7 Series doing the heavy lifting this quarter, that created a massive beat for them on the EBIT margin in at 12.1%. The estimate range was like around 7%. EV sales up 112%. But again, that was down to North America, up 11%. But you look at Europe, sales down 2%, China down 2.6%. So really, it's just a very strong quarter for the automakers, but everyone is very reticent to give a very sort of punchy outlook looking forward, and that's all down to will this pricing sort of hold up? Will the slowdown bite? And also we had Ford out today, they're cutting jobs. So if you can't get that margin up on the pricing, you're going to have to look to save costs somewhere.
Yeah, concern around pricing with the Tesla news and also demand in Europe, certainly in focus. Oliver, thank you very much. Oliver Crook joining us there from Berlin with the latest on the auto sector. That is it for Early Edition. Surveillance is ahead. They will be talking to Ben Laidler of eToro. This is Bloomberg.
politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
We've got inflation that looks like at best it's moving sideways, and that's not enough for the Federal Reserve.
We don't know entirely that we're done. We can't fully rule out action in June at this point.
They definitely want to have the option not to hike at the June meeting.
The statement all but basically admits to this is a pause. The risks are that now financial conditions in the regional banks, of course, will tighten.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We never left. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P 500, broadly unchanged, negative 0.1% on the S&P. If you want a major move, PacWest, that bank, the regional in the pre-market, negative 37%. Fantastic reporting, tremendous from Matthew Monks overnight, saying PacWest has been weighing a range of strategic options, including a sale, according to people familiar with the matter. TK, they stock down hard.
Matthew Marks talking to Jerome Powell, 2 hours afterwards. Really interesting day, truly an historic day off of the Bloomberg reporting that we saw. I know the FT has picked it up as well, with Piper being the bank du jour for PacWest. It's to the camp that says you can't have just one bank fail, two banks fail. There's reason these banks are challenged. It has to do with Fed strategy. It has to do with prices down, yields up, and you got to believe there's more out there.
Let's get to the statement from PacWest. Following that story, the bank has not experienced out-of-the-ordinary deposit flows following the sale of First Republic Bank and other news. They went on to say our cash and available liquidity remains solid and exceeded our uninsured deposits. Now, I want to talk about the deposits and just go through a couple of numbers for our audience. So this came from PacWest yesterday. They said total deposits are $28 billion as of May 2nd, with insured deposits totaling 75% versus 71% at quarter end and 73% as of April 24. Now, I want to compare that 75% insured deposits with SVB, where SVB had more than 90% of total deposits being uninsured. Now, PacWest will come out this morning, Lisa, no doubt, tomorrow, the day after that, and they can keep saying the same thing. We're a very different bank.
And it won't matter. And this is, I think, the key distinction. You feel that kind of angst with right now people trying to game out who the weakest player is and then drive the shares lower, because this isn't just a solvency issue with respect to attracting deposits. It's also just a simple math issue. Where rates go higher, it is harder for these banks to incentivize depositors to come to them, especially if there are concerns about their existence going forward. So right now, they can try to talk with partners. They can say that they're not really an any kind of dire straits, and still those shares significantly lower and not really getting any kind of bid.
This is something, Lisa, we've discussed over the last couple of days. Do we have a fear problem, return of capital, or a greed problem, return on capital? The former is only going to be addressed with a change to the FDIC limit. The latter can only be really addressed by the Federal Reserve moving something with interest rates, and I didn't get any indication of that yesterday.
Drew Mattis of MetLife, I keep going back to the statement of his because I thought that it was really salient, saying, what a missed opportunity from the Federal Reserve to provide relief to the banks. An unexpected pause could have flushed out shorts in the sector and created more breathing room at a time when they are concerned about the balance of risks. Was an extra 25 basis points of a rate hiking cycle really just pushing banks that already were vulnerable to reputational risk if nothing else?
I'm going to call it the distortions Thursday, and it's plural, distortions. And we're looking at deposits, and I think that's true, John, for certain banks, and maybe there'll be more out there we don't know. Far more, maybe it's about real estate. This is Putzier in the Wall Street Journal. Brookfield's Los Angeles office company is roiled by defaults. Now, that's commercial property in L.A. That's where PacWest is in Beverly Hills. But you know, I tell you, this is a set of distortions that are out there that we're seeing with a vengeance after the Monks reporting yesterday.
This is the next step, and you're right to bring it up, Tom. The discussion that Lisa and I are having is about a rate shock. It's about how to respond to a rate shock. The next step, perhaps, is credit fear. I think with PacWest and the story yesterday and the way everyone responded to it, it's not for me to say that a stock should be or shouldn't be up or down. Yeah. That's not my job. That's not any of our jobs, and we'll talk to investors about that and analysts as well. I just think what happened yesterday was just the words PacWest and strategic options, because we've seen how that plays out. We know the template for that. At least we think we do. So you see a bank and you see the words strategic options and you start to think, oh, I've seen this play out before. I know how this works. I know how this ends. It ends quite badly.
Especially because at this point, why would anyone swoop in, have any deal without some sort of loan loss share agreement with the FDIC, which is exactly the template that you're talking about?
Getting a bit of news from TD Bank and First Horizon, mutually agreeing to terminate their merger pact. TD Bank, First Horizon cite uncertainty around regulatory timing. First Horizon shares down hard in the pre-market. They're going to host an investor call a little bit later on today. So here's the latest. First Horizon is down more than 40% in the pre-market off the back of this. TD Bank TK essentially unchanged.
TD Bank is Toronto Dominion. We speak to Priya Misra and others in their strategy and economics division, Mark McCormick as well. It's a Canadian success story coming south across the border. First Horizon, Memphis, Tennessee, 7,000 people, much, much smaller bank as well. And I'm getting up this down hard, as you mentioned it, John. And on the chart here, we were at 15 and we're enjoying a center tendency, $9.25 right now.
Let's get through the price action off the back of that, TK. Thank you. Looking at the equity market, negative 0.2% on the S&P 500. Yields a bit higher by close to 3 basis points at 336. A little bit later on this morning, an ECB rate decision, a news conference with President Lagarde, then onto Apple earnings after the close. Then tomorrow, payroll's just around the corner. Joining us now is Ben Laidler, global market strategist at eToro. Ben, wonderful to catch up with you, sir. I'm going to go back to the question of the week so far. Is it still just idiosyncratic?
Yes, it is, but I don't think that we should downplay it, right? I think we have all the ingredients for a new growth scare, and I think equities, certainly in the short term, are probably a bit complacent to that. We've got the lagged effect of these 5% interest rates. We've got this bank scare, which continues to smolder and has disproportionate impacts for commercial real estate and small caps. And we have the debt ceiling showdown, which is sort of less than a month away. I think all that is going to accelerate the growth slowdown, which has barely started yet. That's the bad news. But I don't think this is necessarily, bad for the market in the sort of medium term. I think it just accelerates everything, the growth slowdown, but also the inflation slowdown. And also it resolves this debate, this standoff between the Fed, which says no interest rate cuts this year, and the market, which I think is going to be right, and we're going to see interest rate cuts this year. And I think that is going to be ultimately good for the market, which is full of these sort of defensive, long-duration tech and healthcare stocks, which are especially sensitive to this.
Time horizon important, Ben, with everything you've just said. I have to say, comparing what you just said in the last 60 seconds to what you've said repeatedly over the last few months, Ben, this is a shift for you, isn't it?
Maybe in the short term, but again, we were always going to get this growth slowdown, right? Just with the Fed hiking interest rates to 5%. The two new ingredients are the tightening of financial conditions with what's going on with the small banks and this sort of smoldering, never-ending, crisis, and the debt ceiling. And I think the debt ceiling will do two things. I think that's going to tighten financial conditions today, and I think it's going to slow the economy going forward when we get the ultimate deal, which involves less sort of government spending. You put all that together, I think that will slow the economy. I think that will introduce some volatility. And, you know, remember the VIX is well below 20. I don't think equities have barely focused on the debt ceiling yet, unlike fixed income markets, which some of them have, you know, priced in a bigger impact even than 2011. So I definitely think there are signs of short-term complacency. I think the question is, what do you do about it? I think if the market sells off here, if the market responds to some of this, I think you buy it. I don't think you sell it. I think you reposition sort of into it. You know, ultimately, I think this is positive, not negative, because it accelerates the inflation slowdown and brings forward the interest rate cuts.
I love listening to people and their different interpretations of the same series of events. It seems like you and Mike Wilson both agree on the next series of couple of steps. It's just that the market response will be completely different in both of your views. Why is it that this market will fail to price in that growth recession, will fail to decline meaningfully in the face of a lot of uncertainty, volatility, and real concern about profits?
Because we've been so resilient so far. We just had 3.7% consumption growth in the first quarter. We've just had, a less bad earnings season. You know, we've been crying wolf on the growth slowdown for, a year now, and it hasn't happened. But, I think there is I don't think the laws of economics have completely broken down here, right? I do think, the stars are sort of realigning here with the interest rates, with the banks, with, the debt ceiling, with where the market is, right? The VIX is below 20. And I think the fixed income market is telling you very clearly that there are, there are problems coming. I think you need to tweak that with a little bit of respect. But again, I don't think the response to that is to head for the hills. I think the response to that is, get your buy list ready and just be, aware that stock markets are not economies. What's really going to suffer here is small caps, is industrials, is commodities, which are all massively underrepresented in the stock market.
Ben, you're going to be in your coronation pajamas tonight when Apple releases as well. What is the symbolism of Apple, their success, their use of cash? I looked at the share buyback today. Wow. What is the symbolism of Apple given all this turmoil, these distortions?
So three things. One, just the sort of fortress balance sheets, the huge cash flows, the big buybacks. These are the new defensives, one. Two, expectations are very low. Yes, we've had some relief, but, we're not seeing good earnings growth. And we know that. And where's the growth come from this quarter? It's come from the sort of cyclicals. That's exactly what you should be selling, because the slowdown that is coming and the tech names which have, reported these sort of less bad earnings, but still not great earnings, very backward looking. I think those are the things you should be, owning. And then thirdly, these are these classic long duration assets. And if we're looking for places to hide, if we think inflation's coming down, if we think bond yields are going to stay well anchored, I'm just a lot less concerned about this 20-30% premium valuation to the market.
Hey, Ben, wonderful to get your perspective. Ben Laidler of eToro, constructive over the medium term, a little bit cautious in the short term. Your equity market on the S&P 500, despite this conversation about growth risks, banking problems, the S&P is negative 0.2%. Lisa, that's not a big move. Not a big move at all.
Which is Ben Laidler's rationale for why this can withstand some of the growth slowdown and some of the other potential shocks, because it hasn't moved yet. It's been resilient, so that's the reason why it can keep going.
Even with the Standard & Poor's angst that's out there, with only 7 stocks or whatever leading the way, Laidler stepping up in late 2018, you've enjoyed a 62% lift, 12% per year. And the dog of dogs, the Standard & Poor's 500. That's the call. It's the bull market call here. Later, when he was at HSBC,
I was with you. I was with you in the booth. I was with you in the booth.
How much is this just underestimating tech again and again? Because it really is just a couple names that basically drive the entire index.
We can go into that as we cut our team coverage of Apple here. Matthew Monks.
We haven't even talked about the Federal Reserve at all.
I know.
Oh, no, detail.
Nobody, and obviously we all did a lot of reading after the close yesterday. Nobody I saw changed their views following that Fed meeting. If you think they're done, you still think they're done, and if you think they're not, you still think they're not. In the equity market, negative 0.2% in the next hour. Wei Li of BlackRock.
Keeping you up to date with news from around the world.
world. With the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell has opened the door to a June pause for interest rate hikes. Policymakers raised rates for the 10th time since early last year. And Powell hinted that might be the last one. But he did stop short of declaring victory in the fight against inflation. Meanwhile, the European Central Bank is poised to slow the pace of interest rate increases today. That's after its preferred measure of inflation eased for the first time in 10 months. Officials at the central bank are expected to raise a deposit rate by a quarter point to 3.25%. PacWest is trying to calm markets after a 60% stock plunge that made it the new focus of concern over regional banks. The bank says that core deposits have actually increased since March. It also confirmed it's talking with potential investors. Now, shares plummeted yesterday after Bloomberg reported PacWest was considering strategic options. In Atlanta, police have arrested the suspect in a fatal shooting at a medical building after a manhunt that lasted several hours. They say he stole a vehicle after then he attacked and then later fled on foot. And one person was killed and 4 others wounded. The suspect's sister says her brother was not mentally stable. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. All eyes turn to the U.S. job market.
There are already some signs the labor market is going to weaken.
We've just started to see recently claims just tick a little bit higher.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a really, really good report for minorities.
Can we get a painless disinflation?
This is a chairman that wants a 4.x% unemployment rate. The microdata doesn't show that.
The April Jobs Report, Friday on Bloomberg Television and Radio.
There were 3 large banks, really, from the very beginning that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period of, is an important step toward drawing a line under that period of severe stress.
The word kinda doing a lot of work in those comments for Fed Chair Jay Powell. Compare and contrast that to the move we're seeing in PacWest this morning. That stock is down and down hard. More broadly, the equity market on the S&P 500 doing okay. We're negative here by 0.2% on the S&P. Yields are a little bit higher by 3 basis points, much lower in yesterday's session. Your 10-year 336.55 in the FX market. Bramo can tell you where the euro is against the dollar.
It's 110.
She's on
Thank
top
you,
of that.
Lisa.
Anytime.
110.54, just still in and around those kind of levels, Tom. A little bit later after the close, of course, Apple coming up. 7% of the index in one single name. 7% of the S&P 500.
Andrew Mellon would tell you this is normal. This is normal. When you have angst and distortions, as we're talking about, you end up with concentration in a few ideas, whether that's good or bad is a point to be debated. We looked at the CAC 40 in France, and some 24% or something of the value of the French stock exchanges in 2 stocks.
It might be normal, but I just want to put this into perspective. The fact that Microsoft and Google now account for 14% of the index, that's a record for those 2 names. So it might be normal, but it is an extreme version, perhaps, of what normal looks like.
What we do here, the heart of what we invented here with Bloomberg Surveillance is aggregation, with Matthew Monksjohn leading last night with Bloomberg and Bloomberg reporting on the PacWest debacle. But it's everybody out there in journalism pushing against, as you heard Jerome Powell in the beginning. We're under control. It was 3 banks. We're under control. We've got things under control. And there's anybody that's been through this stuff, including our next guest, that's just baloney. They're not under control. They're managing it tick by tick.
Well, clearly they want to signal calm. But something that I was really thinking about yesterday evening, Tom, following those comments from the Fed chairman, in trying his best to sound responsible, is he running the risk of being irresponsible? And I wonder whether we're at that kind of tipping point now, given what's developing and what that news conference sounded like yesterday.
And the shock of Clarida saying we're not going back to 2%, or I thought Dudley was on fire yesterday during our Fed show. Bill Dudley was as I've never seen him. What's important here, folks, is it's not about verbiage, it's about action. So what's the action in the pause language to start to calm the markets with price down and yield up? That's what we're waiting for.
What did he say about the pause? We discussed it, but we didn't make a decision on it. We might be getting close to it.
We're in control. We're in control.
Something like
that. We have options. I use this silly stat phrase, choice set. You know what the choice set is this. PacWest this morning. And maybe First Horizon, you see that. John, review that. First Horizon from 15 to 9.
Yeah, the latest news from them is that TD Bank and First Horizon mutually agreeing to terminate the merger pact. I think this is interesting from TD's side of things. Unable to obtain the timetable for regulatory approvals. Now, Tom, is that because the regulator's busy doing other things? It's kind of an interesting comment, isn't it, Lisa, to get from them?
Well, it's also that they want out of the deal. I mean, how much is that the issue, too? Valuations have plunged.
Well, yeah, they have, and then real estate is a big mystery here as well. Right now, truly expert on this, Mayra Rodriguez-Valderas joins us with MRV Associates with just terrific experience on managing the message and the reality faced in bank boardrooms. Mayra, in your note, you have too big to fail, and there's a too big to fail version 2023. What is that? What is too big to fail now versus when Andrew Ross Sorkin wrote his classic book a few years back?
Well, we're certainly much more interconnected at every level in the United States and also globally. And this also really ties Chairman Powell's hands to a certain extent. You've got, last year you had 90 central banks raising rates. You still have the ECB raising rates, Bank of England, others. And so the Fed is dealing not just with a domestic inflation problem, this is global. If key central banks are raising rates, the Fed then runs the risk that if it also doesn't keep up, it's not going to be able to control inflation here, and you can have capital outflows. There are no walls for investors. American investors can go invest where there are higher rates.
Do they need to be more aggressive in their language on pause to say we're going to set up pause for multiple meetings and monitor the data, et cetera? I sound like Yul Brynner, et cetera, et cetera, et cetera. Do they need to change the pause language?
You know, that's an excellent question. When I started working at the Federal Reserve a couple of decades ago, there wasn't any of this signaling. The FOMC press releases and even the pressers, which were much briefer. Now we're in an era where everybody is looking for all of those cues and clues. and even to the point of hand-holding. And really, any Federal Reserve chair is in a no-win situation. If he were to say, ladies and gentlemen, we're going to pause, you would immediately have people who would say, oh my gosh, things must be really terrible. On the other hand, if he says, we're going to march forward and raise rates, that's going to make a lot of borrowers, especially those that are leveraged, really panicky. It would make the banks holding that kind of debt also quite panicky, because we have a lot of consumers and companies that are very, very leveraged presently, almost at historic levels. So the language was, we are waiting for the data, we're still looking at all the factors, and then we will consider a pause. And I know it's frustrating. Everybody wants to be told this is exactly what's going to happen, but there's always been uncertainty in the markets, and people have to have a historical perspective that we are always in uncertain times. No one can guarantee what's going to happen tomorrow. Look at what's been happening now with the bank turmoil. We've moved from big regional banks to PacWest, which is a much, much smaller bank, but they too have been having interest rate risk management problems. And it's also the short sellers. Think of all of those market participants who are benefiting greatly from chasing after every bank that they suspect could possibly have a problem. And they make perception, they turn it into reality, unfortunately.
Myra, just to sort of build on that, there is a question of whether this angst that we're seeing in regional banks can be stopped without some sort of policy response, whether it's cuts in rates or whether it's a potential shift in terms of ensuring a greater amount of deposits for a more cheap kind of price. What's your view? Can this be solved without some sort of policy response, or are we going to just continue to see this cascade of potential weak players?
I think what's important here is we do need policy responses at this stage. And if it is going to be to ensure a greater amount or different types of deposits, then that is going to have to come from the Federal Deposit Insurance Corporation, the FDIC, and that it should be the bigger banks that pay for that insurance. It shouldn't be the community banks that have nothing to do with this. And that's going to be a problem. You're going to have the bank lobbyists fight against that. In terms of monetary policy, the problem is, even if the Federal Reserve were to pause rates at the June meeting, we're still at rates that are at the highest in 15 years. So it's not like you can just turn off the spigot. And my big fear is that we're already starting to turn from an interest rate risk story to a credit risk story. You've had default rates that have been ticking up since last fall.
Yep.
They're increasing now. You have telecoms, retail, pharmaceuticals. All of those sectors are already at above average default rates. And of course, the banks are the ones that are holding those loans. So we're turning from an interest rate risk story to an asset quality story.
Myra, we've got to leave it there. Thank you for that. Myra Rodriguez Valladares of MRV Associates. Building on the conversation we're having here, we've had the rate shock. Is the credit shock just around the corner? And is that what we're starting to play with in some of these regional names? June 14th is the next Fed decision. And let me tell you, I have got no idea where we are on June 14th. Where are things going to be?
I'm not sure we knew where we were yesterday. It was a crazy press conference. It was like a non-event, and there it is.
Jane Foley of Rabobank coming up next.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Live from New York City this morning. Good morning. Welcome to the program. This is the situation in equities right now. Negative 0.1% on the S&P. After the close a little bit later, one big name making up more than 7% of the S&P 500 reports earnings. It's Apple. The Nasdaq going into that positive 0.2% in the bond market. You would not know what was happening to some of these regional banking names looking at this. The 2-year, 10-year, 30-year looks a little something like this. Yields are higher by 5 basis points on a 2-year, 385.21. This bond market's been all over the place the last couple of days. I said it on Monday. Yields are up by more than 10 basis points. On Tuesday, they were down more than 10. And then on Wednesday, a repeat of Tuesday. Then this morning, higher once more. It has been like a meme stock, Tom, in the bond market over the last few weeks.
What I looked at last night was a 3-month, 10-year spread. I've said a lot about it recently, so others have picked it up as well. And John, in the shock of Matthew Monk's story on Pacific West, we went out near 2 full percentage points of difference in yield between the 3-month T-bill and the 10-year. We went out to 193 rounded up 9 basis points. All you need to know if you're keeping score at home is I've never seen that banner before on TV. I've never thought about it. We're out solid 3 standard deviations over 30 years. Anyone who studies the mathematics of this would say there is massive stress within the system.
You mentioned PacWest. The stock is down by more than 40% in the pre-market at the moment. That stock a whole lot softer, negative off the back of that reporting from our colleague Matthew Monks yesterday evening that PacWest has been weighing a range of strategic options, including a sale, according to people familiar with the matter. This was a direct response to that from PacWest. The company said they have been approached by several potential partners and investors. Discussions are ongoing. The company will continue to evaluate all options to maximize shareholder value. They also offered a bit of detail on core customer deposits. Lisa, I'll share those numbers with you. They've increased since March 31, with total deposits totaling 28 billion as of May 2nd, with insured deposits totaling 75% versus 71% at quarter end and 73% as of April 24th. The communication they gave us when they released earnings is that things were stable. In fact, deposits had improved.
You know what's not stable? Their share price. Their share price is down more than 40%, even with some of these disclosures as people try to game out if someone does come in to buy them. There's also this issue of exactly what you said before. If the playbook is go down to 0 before the FDIC sets in and basically says, look, we'll share the losses with you. Well, yeah, we'll share the upside too, but you can really get most of that. Why wouldn't somebody wait for that?
I don't think this store is any different than the others, the color and the shades there, but I'm looking, this is on the Bloomberg, folks. I'm not making these numbers up. John, deposits went from 35 gazillion down to 28 gazillion, as you just mentioned as well. While they were doing that, they were loaning out money and this, that, and the other. Let's say they weren't being First Republic Bank, and those loans go out, and some of them are in bond equivalent or bond pricing where it's priced down. The loan value goes down now, and they've got to match that, and they run out of capital. I mean, that's the way this works. I mean, that's just basic accounting.
You seemed like you were keen to say something.
No, no,
you,
no.
You gave me the lean.
No.
Okay,
She
you
gave
got,
me the
okay.
Bramall lean.
I got the Bramall lean.
I saw it. I saw it.
You got the Bramall lean too? I did as well.
Look, honestly, I just will say this. We're speaking of two sides of the same story, right? Basically, this is a sort of escalating problem. And the bigger question this morning is, first of all, whether Jay Powell really is on this, really has a handle on what the issues are.
Okay.
Number two, what kind of policy response there needs to be. And number three, if it's okay, if we're just going to see an SNL kind of crisis or issue or whatever you want to call it, and it's just going to kind of basically weed out some of the weaker players.
We got to go to Jane, but if there's nothing nefarious here, they can't call up the bank and say, fix this. The bank has to fix it. And look, John, as you mentioned, and Matthew Monks mentions, there's strategic options.
I confused my Bramall leans. I think that was I'm checking out. I'm not listening to you, Tom. I think that's what that was. I think that was it was one of those.
Welcome to my
I thought it was one of those.
Welcome to my life.
This is I've got something to say.
Like this.
But this is.
Oh my God, let's move on.
I'm done here.
Jane Foley to save the show, head of FX strategy at Rabobank in London. Jane, thank you for putting up with us as we look at American banking. How does the American banking crisis fold over into your foreign exchange analysis, or is it discrete and separate over there?
Well, you know, I think many people, certainly in Europe, are looking at this and hoping that it is discrete and separate, that this is idiosyncratic. We've heard that word a lot for the US banking sector, but I don't think it's that simple. But, you know, there's other real pressure points here. You know, you talk about the stress as exhibited by the bond market. I think the market is caught up in this sort of global financial crisis mindset of assuming that we see these pressure points, we see the stress, and then the central bank will come in and cut interest rates. But actually, we are in a different environment now. We cannot assume that the Fed is going to be cutting interest rates this year when we know that the Fed is still targeting inflation, and inflation is very sticky, and that's a problem. And that suggests, as long as they've got that 2% inflation target, it suggests that, you know, we might have more of these pressure points, more of these crises as the global economy gets used to this higher interest rate environment. And that means that these crises may not just be about the US regional banks in 3, 4, 5 months' time.
Jane, are you suggesting then that you believe the Fed will keep rates at 5% even as we go through a painful adjustment?
I think that's quite likely. Either that, or we have to, you know, ask the question, are these central bank inflation targets too high? And I think the answer to that is, well, quite possibly yes, because I think we are in a different environment for inflation as relative to the sort of post-Cold War, up to sort of Trump, up to the pandemic time. I think we are in a different environment now. We had Lagarde just a couple of weeks talking about, you know, geopolitical fault lines and different trading environments, and that adding on inflation. We've got supply chain adjustments all around us, if not for geopolitical reasons, but, you know, for because of COVID or because of climate change too. Is that inflation? We've got labour market shortages all throughout most of the OECD. So we're in a different inflationary environment. We can't assume that those central banks will just cut interest rates because that's what they've done before when we were in a low inflation environment. And that means we could have more of these pressures. And we know also that the central banks can't just say, oh, you know what, we're going to change the inflation targets because they're no longer appropriate, because we know that credibility is an issue, and they can't just do that so easily. So I think we are going to have more stress exhibited across the markets in the coming months.
So basically 2023 can be written with the title hiking into stress, hiking into weakness, and that seems to be the theme across the board. There will be hiking into weakness potentially in certain pockets in Europe in less than 2 hours' time when the ECB is expected to raise rates by 25 or 50 basis points. Are you expecting them to comment at all about the officer survey, the lender survey that just went out, where you can see a real credit contraction in the Euro region in a way that people are very concerned about in the United States?
Yeah, you know, I mean, I think that really is pertinent. We are seeing this tightness of credit conditions coming through in Europe. It's there. I mean, if you look at the data so far, well, you know, you can look at the GDP data for the Eurozone on Friday and say, yeah, you know what, that disappointed a bit. But at least there was growth. At least we avoided recession in the Eurozone over the winter. But as we move forward into the second half of this year, it is very likely that we are going to see a lot of that tightness that is now in those credit conditions being reflected in economic data. We think just the Eurozone economy will stagnate in the second half of the year. And then you've got to ask the question, well, if that's the case, what's the euro going to do? And we think it's quite likely that it's probably about as good as it gets right now for the euro.
Jane, the heritage of Rabobank is simple. You guys own hedging. You're on the other side of the speculative trade, helping businesses worldwide. Through your prism, what does the Pacific Rim look like in China in particular? Are you seeing a reopening after the COVID disaster?
There is a reopening, and perhaps at a pace that's perhaps disappointing, many people. But there is a reopening, and one thing that, we are seeing, for instance, in Australia, look at the trade data there. That's pretty strong because of the reopening in China, and also because of the lifting of some tensions there. So there is a reopening, but I do think that the pace at which perhaps is a little bit slower than many people had expected, around about the turn of the year when we saw that reopening trade really get going. So yes, it's happening, but there is a slowdown anticipated, a recession anticipated for the US at the end of the year. The Eurozone probably going to stagnate, and China, the growth there probably disappointing. And I think if you just look, for instance, at the oil market overnight, we see a lot of that disappointment reflected about the outlook for the global economy.
Great to catch up, Jane. Jane Foley of Rabobank going into the ECB a little bit later this morning. Comments there at the end on China and the recovery there. Do you want to do that through the corporate lens? I think we can. Estee Lauder yesterday came out with earnings. Their stock got obliterated in yesterday's session by close to 20%. And the commentary that we got, so the beauty company had to come out and cut its forecast for the third time in 6 months. The third time in 6 months. And that's a company that gets a lot of revenue out of China. And they said as travel recovers more slowly than expected in its key market, China, that doesn't speak to the narrative of the last couple of months.
I have no knowledge here other than to say I don't think you conflate them in with luxury. I'd love for people to email in here and say, is Estee Lauder going to the middle market or the fancy market? And I'm not sure which.
It's actually a really good point. There is a question of strategy versus larger kind of geopolitical developments. And there is a question of whether they're sort of marooned between luxury and more everyday types of makeup purchases at a time where post-pandemic, there's been a huge shift in that entire industry and how it's been consumed.
I'm just going to the website, Tom, to get you some Futurist Hydra Rescue Cream, which is $50.
I've looked at that. I'm sorry.
Revitalizing Supreme Plus Moisturizer comes in at $120. I mean, that feels pretty luxurious to me.
Well, and people are spending more on all of their, creams and things.
Well, after our 14-hour day yesterday, I think the Estee Lauder Advanced Night Repair Serum at $220.
I'll take some of that, yeah.
That sounds good.
TK.
It's particularly good stirred and not shaken.
I'll one-up you for Christmas. I'll get you a Pure Color matte lipstick for $36. We could do this all day, couldn't we?
No, this I know. This, folks, I understand this.
Oh, yeah.
Matte lipstick at $36. That's a giveaway. That is not priced at the prices you see in the basement of Bergdorf Goodman.
Oh, there we go.
I can tell you this from careful reporting.
There's a man who knows his lipsticks.
What I know is if you can't pronounce the name, it's probably French and expensive.
That's true. I'm with you.
Guerlain or something. It's
something like that.
I can't pronounce it.
Is that Swiss or French?
We don't ask. They take you.
It's like when Bramo was left alone with me and we were talking about, what were we talking about? What does LVMH not own?
Oh, yeah,
we just named a bunch of companies they already
owned, and then we got messages, people writing in being like, you guys,
they don't own Gucci, but it's challenge. They take U.S. dollars. That's what I